Hello people, so continuing our revision session. So now next topic we are about to revise is one of the big ticket topics, amalgamation of companies. Amalgamation of companies is backed by a standard. That standard is accounting standard 14. AS 14 talks about how the accounting of amalgamation should be done. So amalgamation simply means one company taking over another company. ArivuPro, let's say purchasing another academy. That is also amalgamation. Or let's say ArivuPro and another academy came together and they formed a new company. Right? So if two companies come together and open a new company, that is also what's a amalgamation. One company purchasing another company is also amalgamation. 2 or 3 companies merging also is a amalgamation. Both are covered by the same standard called AS 14, meaning the accounting part of it. Yes. All right. Now for accounting per se, AS 14 says you can account using one of the two methods. You can account it under one of the two methods. Either it will be a purchase method or a merger method. Either purchase or merger. Merger is also known as pooling of interest method, also another name. Okay, sir. This is just for the sake of accounting. Now the next question that will come in our mind is, sir, when should we go for accounting under purchase? When should we go under merger? Sir, for merger, AS 14 has given 5 conditions. For it to be a merger method accounting, we have to test how many conditions? 5. If all the 5 conditions are satisfied, then it becomes merger. Even if one among that 5 fails, it automatically becomes purchase. Done. Anybody remembers what are those 5 conditions for merger? If it has to be a merger method means, now there is 2 companies. Tell me once again, what do we call them? A purchasing company, selling company, right? Who will buy whom? Purchasing company will acquire selling company. Sir, when you acquire some company, then that selling company ka assets and liabilities now belongs to whom? Purchasing company. If you want to account it under merger method, the first rule or the first condition is every single asset of the selling company should be purchased by the purchasing company. All the assets and liabilities of the selling company should be taken over by the purchasing company. Not even one asset should be left out. Not even one liability should be left out. Everything should be taken. And they should be taken over at book value. Book value means the value shown in the books, or carrying amount, or whatever you say, right? At whatever value selling company is showing that asset and liability in their balance sheet, at that same value new company should take over. That's the second condition. They should take over at book value. Third one, sir, will somebody sell the shares at free of cost? Now let's say, suppose ArivuPro wants to buy another company, another academy, let's say. Will the other academy owners sell their shares at free of cost, or ArivuPro has to compensate? Yes, no. So that is the third condition. The compensation payable to whom? Equity shareholders. Maybe first I'll talk about this. Equity shareholders who are owning at least 90% shares in the selling company should become equity shareholders in the purchasing company. Tell me once again, what is the condition? Who are the owners? Equity shareholders and preference shareholders. Here the condition is on the equity shareholders. Selling company has equity shareholders, right? Whichever shareholder is owning how much percentage? 90% shares. Where? In selling company. They should also become new shareholder in which company? New company or purchasing company. Basically, that means what? How can an old shareholder in selling company become shareholder in the new company? Settlement is done in cash or settlement is done in shares. Suppose I give equity shares. Suppose the purchasing company, suppose ArivuPro tells the other academy shareholders, I will give Arivu company ka new shares. I will give Arivu company ka new shares. So what will happen? Earlier the shareholders were holding shares in which company? Selling company. Now they got new shares of which company? Arivu. That is what is the condition is saying. The shareholders who are owning 90% shares in the selling company should also become shareholders in the new company. So in the new company, how much percentage they should own? That could be 1%, it could be 0.5%, it could be 100%, it could be whatever percentage. That is not a criteria. Basically, whoever is owning 90% shares in the selling company should also become shareholders in the new company. In the new company, they can own whatever percentage of shares. It does not matter. That's the third condition. Okay, Sarji. Fourth one. Sir, you have to compensate the owners. Who are the owners of the selling company? Equity shareholders, preference shareholders. To the equity shareholders, no, you have to compensate only through equity shares. The compensation to the equity shareholders of the selling company has to be made only in equity shares. For it to be which method? For it to be merger method. If you are paying cash to the equity shareholders of selling company, sorry boss, it will not become merger. Automatically it will become what? Purchase, because condition has got violated. That's the fourth condition. Yes, sir, people. That settlement, what you give, no, we give a fancy name. That settlement, here we are using settlement, no. In AS14 terminology, we call it as PC. PC as in purchase consideration. Okay. So the purchase consideration payable to the equity shareholders of the selling company has to be compulsorily through what? New equity shares only, and not through any other mode. Okay. Last condition, after taking over the business of selling company, you should not scrap the business, but rather you should continue the same business. Suppose selling company was in the education field. A new company, one company purchased that selling company. After that, they closed it down. That should not be the case. The business of the selling company should be intended to be continued or carried on. How long? Section is silent on that. If all these five are satisfied, it becomes what, sir? Merger. Even if one of these fails, it becomes purchase. That's how to identify whether it is a purchase or whether it is a merger. Any confusion in this? So usually they will not, question will not ask you to test this, because question only will specify whether it is a purchase or a merger. When question says it is purchase method, now you don't be a Bruhaspati and tell condition violated. No, not required. Don't question the. If the question says purchase method, follow purchase method ka account. If the question does not specify, then you will test these five conditions and figure out whether it is a purchase or merger, and accordingly give the treatment. That's it. Okay, Sarji. Now we got to know two things: purchase method and merger method. Now we are going into the accounting side of things. There are not too many concepts in amalgamation. Most of the things are numbers only, but if you know these sort of bases, more or less majority of the amalgamation questions you can handle is what I feel. Okay. Yes, sir. Nothing, sir. First method of accounting, let's dive in. What is the first method, people? Purchase method. In fact, if you remember our class notes, I've given you certain steps. Same steps I've called out in chart book. If it is purchase method, the first thing you will do is, can the purchasing company acquire selling company at free of cost, or they have to settle something? Settle. That settlement value only we give a fancy name. What is that fancy name? Purchase consideration. So first step is you can calculate PC, or there's no order, you can calculate in any order. Calculate something called PC. Dana ji? Okay, ji. Sir, whom will you pay the settlement? To any Tom, Dick and Harry or owner? Who will get the settlement? Anybody? Will you get a Infosys acquired Wipro? You are neither a shareholder in Infosys nor you are a shareholder in Wipro. You wrote a mail, Nangu PC Kodi, give me also PC. You will get a no. So PC is given to whom? PC is given to whom? Owners of the selling company. Yes, sir, people. So that is the meaning of the term PC. So PC means amount payable by the purchasing company to the owners of the selling company. And who are the owners in the company? Equity shareholder. So the new company, whatever they give it to equity shareholders and preference shareholders of the selling company, that will come under the bracket of this. You can give them cash, you can give them new equity shares, you can give them new preference shares, you can give them debentures, you can give them assets, you can give them whatever the hell you want. Doesn't matter. Whatever you pay to the owners will come under the calculation of PC. So, okay. This is very important. Many students do some mistakes over here. Okay. It's not necessary that you have to give equity shareholders equity shares only. To equity shareholders of selling company, you can also give debentures. whatever you give it to the owners will come under the ambit or bracket of PEC. Is that part very clear for everybody? Okay, this is done. Second one, no, you calculate something called net assets. You have to calculate something called net assets. Sir, name only is giving a lot of idea. Net asset. To net off something means what? Adjusting, correct? No. So here we are calling it as net asset means, how do you calculate? Forget about what I have written. By listening to the term net assets, what's coming to your mind? Net assets. So from the assets, if you reduce the liability, that final remaining number only becomes what? That's all is net assets calculation. Okay, Naji? Fine, Naji? Okay. So now we're just refining that a little further. Net asset means assets taken over by the purchasing company at what value? Agreed value. Minus outside liabilities taken over by the new company at agreed value. Sir, go back to the name. What is the name of purchase? Sir, under merger method, can you ignore any asset or you have to take over all assets? Under merger method, all assets, all liabilities should be taken over, and they should be taken over at what value? But under purchase method, is this mandatory to take over all assets or purchasing company choice? Purchasing company choice. Yes or no? Because some assets could be worthless. Yes, no. Correct, no? So there is a possibility that in purchase method, where some assets may be taken over, some may not be taken. So net assets means it will only include those calculations. What? All assets or only assets taken over? Taken over. Because somebody will compensate for all assets or only for the assets they have taken over. They only, suppose you have a bike. Oh, there are two bikes. So you have purchased only one. You will pay two bikes ka value and purchase or only one? Only one. Because you have purchased only one bike ka value you will pay. The other bike, what if someone showroom people say there is another bike, give me value of that. What will you tell? Hey, sorry, I did not buy that. I purchased only one bike and I will only compensate you for one bike. Same thing here also. Net assets means calculation will include only assets, specifically not what? Total assets or assets taken over? Assets taken over at what value? Agreed value. Sir, what is this agreed value, sir? Sir, what's your name, Acha? Premada? Oh, he's in a different mood only early morning. Name only is kept weird, Allah? Yeah, nice. So, our Prem Garu. Okay, I think I'll have to modify the example. Okay, let's maybe go ahead with this. Our Prem Garu owns a building. Let's say in Nungambakam only. Rich fellow he is. I don't know why he's doing CA. We'll do it anyway. So he owns a building in Nungambakam. Let's say he's a chartered accountant student now. So he's maintaining books of accounts. After daily accounts class, he'll do this only. Go and pass journal entry for his assets and liability. So in his balance sheet, he's showing the building, let's say at 25 lakhs. In his balance sheet, he's showing that building at 25 lakhs. Sir, why, sir? Because he purchased it 10 years back. He purchased that building how many years back? 10 years back by paying how much? 25 lakhs. Today, no. 1 0 has increased. Its value has become 2.5 crores. I think Nungambakam is more costly, I think. Let's make it 25 crores. Let's make Prem happy in the morning. Okay. So 25 lakh worth asset now has become 25 crores. Okay. Now Prem wants to sell this building. Good amount. No. He wants to sell the building. Now I am a chartered accountant. I told, give your books. He gave me his books. I don't know why, but he gave. Papa, maybe he felt, look at my face, he felt power and he gave. I saw that he's showing in his balance sheet, he's showing the building at what value? 25 lakh. I wrote one check. 25 lakh, Prem, take. Sell me the building for 25 lakh. Tuck, I wrote the check and gave it to him. How much value? 25 lakh. Prem, no. Tear off that check, sir. Why? Why? That's 25 lakh is the market value or book value. Because in accounts, we follow historical cost accounting. He purchased it for 25 lakh. So he's showing it at 25 lakh. But today its value is 25 crore. So today if he wants to sell that building or land or whatever, he will not sell it for 25 lakh. He sell it for 25 crores. Now means when, imagine the same context in now, forget the asset now. One company is purchasing another company, right? So selling company ka assets will be taken over at book value or market value. Market. That's the reason for net asset calculation. We always take not the book value, but agreed value here refers to basically your market value. It's a negotiated value which will be provided to you in the question. Fine now, people. If agreed value is not given, then the assumption is book value, agreed value are same. Fair enough. So check the adjustment and accordingly do it. So net asset means assets taken over by the purchasing company specifically at the agreed value or market value. We want asset or we want net assets? How do you get net assets? From asset, you'll have to adjust liability. Correct? So that's hence I've written here minus. Is it necessary all the liabilities should be compulsorily taken over under purchase method or negotiation? Some liability can be taken over, some liability need not be taken over. So again, rephrase. What will you write here? Minus what? Minus total liability? No. Minus liabilities taken over by the purchasing company at what value? Same thing. Assets at agreed value, liabilities taken over also at agreed value. That netted off number only we call it as what, sir? Net assets. First. Got it? So these two you'll have to compulsorily do. Put up one working note for net assets, put up one working note for purchase consideration. Easy now. Okay, let's take some hypothetical number for the sake of discussion. You calculated net assets and you got how much? 5 lakh assumption. You calculated PC and you got how much? 8 lakh rupees. Okay. No. Think from the purchasing, sir, accounting of this, no? Amalgamation, purchase method, merger method, no? All this method, no? This method is only relevant for the purchasing company. This method, purchase method, merger method and all is only relevant for which company? Purchasing. Because selling company is there anymore or shut down? Shut down. Company which is shutting down, they will worry about method of accounting. No, they will simply worry about what? Closing their books. Okay, so method is only relevant for which company? Purchasing company. Yes, sir. Okay. Now, this number, coming back, I'll tell you once again. Net assets, I've assumed it to be how much? 5 lakh. PC, I've assumed it to be how much? 8 lakh. PC, who will give to whom? Rephrase this once again for me. PC, who will pay to whom? Purchasing company will pay to the selling company. Yes, sir. And the method, purchase method, merger method is also relevant only for one company, which is what? Purchasing company. This scenario, take these numbers and tell me whether purchasing company made a good deal, a profitable deal, or a loss deal. Look at this over here, these two numbers and say. They took over net mein asset ka worth is only how much? After adjusting all the liability, asset ka worth is only how much? 5 lakh. But did the purchasing company pay 5 lakh or 8 lakh? 8 lakh. Yes, sir. For a 5 lakh worth, we have paid how much? 8 lakh. Sir, why, sir? Negotiation. See, if you have to sell something, you want to sell it at 100 rupees. I am saying I will only give you 5 rupees. I will only give you 5 rupees. You want to sell it at 100, I want to buy it at 5. What will we do? Negotiate and agree to some number. So these numbers can be same. These two can be same or it could be different also. In this example, it is different. What is the worth of this company? What is the net asset or worth of that company? 5 lakh. But how much did the purchasing company pay? 8 lakh. So from the purchasing company viewpoint, from the purchasing company's perspective, it's a profit scenario or a loss scenario? Loss. So what AS14 says is, from purchasing company scenario, if it's a loss, that loss, right? How much loss here? 3 lakh. You call it as goodwill. You call it as, you account it in your books in the name of what? Goodwill. Loss scenario, we give it as 3 lakh as goodwill. Yes, sir, people? Because you don't know why you paid this 3 lakh extra for. You could have paid for multiple reasons. Maybe selling company has good employees. They have good customers. They have great assets. Whatever, the reasons could be anything. We are not able to identify. Hence, AS14 says, account it as a dummy asset. Account it as a dummy asset and call the dummy asset as what? Goodwill. This goodwill, no, AS14 says you amortize over. Account it now when amalgamation happens and transfer from goodwill account to P&L account over a period of 5 years in the name of amortization. Yes, sir, people. That's the AS14 ka treatment. Done. Other scenario, other way around means what? Let's say net asset is how much? 10 lakh. Net asset means net worth of the company. How much is the worth of that selling company? 10 lakh. But purchasing company paid only how much PC? 10 lakh is the worth of the selling company because net asset of the selling company is 10, but PC paid was only 9. So now purchasing company sad phase or a happy phase? 10 lakh worth of the company they are able to acquire for 9. So they made a loss scenario or a profitable scenario? Profitable. This happens every day. It's like Pani Puri deal. You go on having it. So revenue receipt, revenue profit or capital profit? So goes off where? So if it's a profitable scenario, then AS14 says under purchase method, you show profit as what? Capital receipt. These are some basics which will come in almost every purchase method amalgamation problems. You need a minute to review, or is it okay that I can proceed? That's what I've written as an equation here. Pakaji, sir, I'll take another 20-25 minutes to explain all the concepts. Then we will take a couple of questions maybe to revise all these concepts once again to get it back. That's okay with you? Okay, next one. I think this is all covered. Next is merger method. Or let's see how much of it you're still retaining. Throw it back at me. What are the things we have read so far? What's the chapter name? Amalgamation. It is backed by which standard? AS14. AS14 covers both the scenario. One company purchasing another company, or two or more companies coming together and merging into new company. Both are acceptable for accounting under AS14. AS14 talks about two methods for the sake of accounting. What are those? Purchase or merger. If question already says merger method, will you test the condition or no testing? No. If question specifies the method, start the accounting straight away. If question does not specify, test the condition. How many conditions? 5. Alright. Basically in exam you will be able to test the first two. The other 3 information usually will not be given. First 2 you will be able to test. Tell me only the first 2. First of all, this condition is for what? Purchase or merger. For it to be merger, all the 5 should be satisfied. First one is what? All assets and all liabilities of the selling company should be taken over by the purchasing company. They will take it over at market value or book value. Right? So the moment, how to identify? In the adjustment, they will say land was taken over at 30% higher value. Land was taken over at 30% higher value. That means higher value means is the asset taken over at book value or something else. If it is not book value, then boss, it can't be merger method. Compulsorily it becomes. Even if one asset, if it is not taken over at book value, automatically it becomes purchase method. That's how to identify. Okay, do that. Alright, now for purchase method, I give you 3 steps, if at all you want to call it as steps. First step, you can say calculate net assets. How do you calculate net assets? Name itself is saying net asset. So from asset, you have to reduce liability. All assets or only assets taken over? Assets taken over. Who will take over? Assets taken over by the purchasing company at book value or agreed value? Agreed value. Minus what? Liabilities taken over by the purchasing company at agreed value. This if you do, you will get net assets. That is the worth of the selling company. Compare this worth with the settlement value. That settlement only we call it as PC. Full form is purchase consideration. PC means what? Amount which is payable by whom to whom? Purchasing company to the owners of the selling company. And who are the owners? Equity shareholders and preference shareholders. You can give whatever to the owners, everything will come under PC. So compare PC with net asset. If you are paid more than net assets, if PC is more than net assets, that means purchasing company made a loss. That loss scenario we call it as goodwill. If it's other way around, meaning if it's a profit, then we will show it in capital. So far, that's all we have reviewed. Okay. Second method. What is the second method? Merger method. Okay. For merger method, sir, whether it is purchase method or merger method, settlement value will be there. You can't purchase any business at free of cost. Correct? Huh? So here the one common element is same, which is what? Calculation of PC. Whether it is purchase or whether it is merger, PC to pakka definitely you have to calculate, and same drama, no change. Yes, sir. So let's go once, or maybe first I'll tell you the steps and then I'll give you a little background. I've mentioned this in class just for context of the new students. I'll just give you this. So in this merger method, if you have to call out the steps, it's not mandatory, but I have done it in all the problems in our class through the step mode. So I'm kind of revising in the same fashion. So the first one is calculate PC. Here, what did we do? Other than PC in purchase method, what else was there? Net assets. Here, instead of net assets, you have to calculate something called paid up capital. Sir, there are two types of capital. What are those? Equity share capital, preferential capital. It will be given in question ka balance sheet. Add them, you will get what? Paid up capital. Now compare these two. PC, you compare it with paid up capital. It can be two scenarios. It could either be a loss scenario or it could be profit. There, loss you used to call it as goodwill. Here, loss you will adjust in reserve. Loss you will adjust it in reserves. Usually you adjust it in general reserve. Usually. If it's profit scenario, you will transfer it to P&L account. Earlier, our ICA used to transfer this also to capital reserve. But then in CA final, they're not required. Okay, there's some Ind AS 103 ka in CA final you'll learn called business combination. There are some provisions there which was kind of clashing, which we will discuss in CA final level when time comes. Hence, now in profit scenario, they won't transfer it to capital reserve, they'll transfer it to P&L. So in a nutshell, if I have to tell it as a formula, I'll tell you the logic of this in case you've forgotten. We have done this, but anyway, I'll tell you. But tell me the steps once again here. What is it? Merger method calculate PC. That's the same. Whether it is purchase method or merger method, PC ka calculation is same. Compare PC with what? There you compared it with net assets. Here you will compare it with paid up capital. If PC, here you can say paid up capital in a way is like your net worth. So if PC is greater than paid up capital, so purchasing company paid a higher amount, meaning they made a loss. Loss you'll adjust it in reserves. Usually you adjust it in general reserve. If it's other way around, if PC is lesser than paid up capital, then the purchasing company made a profit. That profit you'll transfer it to P&L. In the chart book, I had written it as capital reserve. In last 2-3, when the new syllabus came, they from capital reserve, they've modified this and calling it as P&L. Okay, Naji. Sir, didn't understand, sir. Okay, no problem. Let's look at this small example to give you a little better clarity of merger method. 1 minute. Okay. Sir, there is this one guy, Mr. Exo. Mr. Exo, one person is there. He is controlling A Limited also. He is controlling B Limited also. Meaning, let's say 90% of A Limited ka shares are held by X. Similarly, 90% shares of B Limited also are held by X only. Correct? That means this X is controlling two legal entities, called A Limited and B Limited. Any problem? X is a busy person, very, very busy person. He told, hey A Limited, hey B Limited, merge. Hey A Limited, hey B Limited, you both merge because I can't control two companies, you become one company. So that my headache will reduce. And A has controlling stake. He can do it. Yes, no, majority shareholder can take all these decisions in the company. So X instructed what, sir? A Limited and B Limited should become merge. They should merge and become one new entity called what? AB Limited. So these two will get merged and become a new entity called AB Limited. Yes, sir. That means on paper, in agreement, it will say what? When the agreement is drafted, what it will say? AB Limited has purchased A Limited and it has purchased B Limited. That's what legal agreement will say. AB Limited, new company, they have purchased A Limited and they have purchased B Limited. Sir, can AB Limited purchase the company at free of cost or they have to compensate? Compensate. Correct. Compensation will be given to the company or owners. That only we call it by a fancy name. What is a fancy name? PC. So AB will give PC to whom? A Limited, B Limited or the owner? Owner of both the companies, say Mr. X. That means AB Limited will give its equity shares as PC to Mr. X. So why equity shares? Merger method. One of the conditions says whoever is holding 90% shares in the selling company should also become shareholder in the new company. Correct? No. So AB Limited will give equity shares to whom? Mr. X. Now means after this merger, what will happen? A Limited there or gone? Gone. B Limited there or gone? Gone. Which company there? AB Limited. But who's controlling that? Same guy. Correct? No. That means all this drama happened, anything changed or literally nothing changed? Earlier also, these two companies were controlled by whom? After merger also, new entity is still controlled by X. So is it really a business purchase or just a reshuffling? It is just a reorganization. It is not really a purchase. In real terms, this is just a shuffling which has happened. Legally, correct? Legally. Yes. Sir, when shuffling happens, you will pay market value. It's like 100 rupees you have in your left hand. Now you want to transfer it to your right hand. You will transfer 200 from here to here or 100 only. If 100 is there in your left hand, if you want to transfer, you will transfer the same 100 to your right hand. Agreed? That's the reason under merger method, we don't worry about agreed value. We don't worry about market value. Everything will be taken over at. Because the intention or the reality is it is not a business purchase. It is just a reshuffling. It is just a reshuffling. It's a logic. Okay, people. Okay. Give you a minute to process that. Not a minute, few seconds. All this is not required, just saying it for clarity purpose. For exam, if you know this, Zindabad, you are sorted. Little logic of this, just trying to explain through the example, but don't have too much time, but just saying. Okay, Naji? Okay. All right. Now, merger method, by now we got it that it is not really a purchase, it is just a reshuffling. Now, selling company ka balance sheet components, throw it at me. Selling company ka balance sheet, what and all will be there? Chappandi. In selling company ka balance sheet, what and all will be there? Assets will be there. Liabilities like current liability, non-current liability will be there. Then reserves will be there. Share capital will be there. Yes or no? It's an actual business purchase or just reshuffling? Reshuffling. That means now in merger method, no? The purchasing company will take over assets. Only few assets or all assets? Since it is just a reshuffling, every goddamn asset will be taken over. And liabilities will be missed out, or even that will be taken over. That also will be taken over along with reserves. And so in merger method, assets, liabilities, and even the reserves and surplus of the selling company will be taken over by the, because it is not really a business purchase, it is just a reshuffle. Only one component cannot be taken, which is what? Capital. Because capital belongs to A Limited and capital belongs to B Limited. After merger, A Limited there legally, B Limited there legally, or closed? After merger, which company exists? AB Limited. So can A Limited ka share capital be taken over by AB? Because it is worthless. Because A Limited is legally in existence or not in existence? Not in existence. So under merger method, share capital of A Limited and share capital of B Limited cannot be taken. Instead of that, AB Limited issues new shares as PC. So instead of old share capital, new shares will be issued as a substitute. So it is. Okay, now rest everything will be taken over at the exact same value as it is appearing in the selling company ka balance sheet. Goindana, got it up. This is important, throw it back at me. What did we understand? Which method of merger method? Really business purchase or reshuffling? Reshuffling. In reshuffling, mein agreed value required, not required. Every transaction will happen at book value. Any asset will be not taken over or everything will be taken over. Any liability will be missed or everything will be taken over. Everything will be taken over. What value? Book value. Only that or even reserves and surplus. Even the reserves and surplus of the selling company will be taken over by the purchasing company. The only component we are forcefully, we will not have the option to take over will be your capital. Correct now. Instead of this capital only we are giving PC. That's the reason these two we are comparing. And finding out whether we made a profit or whether we made a loss. Usually there will be no profit, no loss. Because it is not really a purchase, it is just a reshuffle. Practically I'm saying there may not be profit or there may not be loss. But ICI wants to test no. So they will change the value. So in your examination question, there will be some loss or there will be some profit. Got it? Huh? Yes, sir. Now, if it is a loss in purchase method, what did you call that loss as? Goodwill. Here, don't call as goodwill. Adjust it in reserve. Because anyway, reserves you're taking over, no? Reserves you are taking over. Hence, loss you adjusted in that taken over reserves only. Fine. Now, if by chance you get a profit, show that profit separately as a P&L. That's all you'll have to do it in merger method as a step. If you need 1 or 2 minutes, or few seconds of processing time, I'll wait. You have got it? There are 3-4 adjustments which generally gets asked. I'll move on to that. Quickly tell. Wait, move on. The new ones are also okay. The first time whom we are connecting with, are we overall fine? Okay, move on to the next one then. Next, something called MO means mutual owing. So mutual owing simply means a transaction which is happening between a purchasing company and a selling company. Before purchase, there is purchasing company and there is also selling company. Can purchasing company do a transaction with selling company? Can selling company do a transaction with purchasing company? Yes. What transaction? Purchasing company can sell the goods to selling company. Selling company may give some service to purchasing company. Purchasing company may give some loan to selling company. Like this, some transaction can happen. Correct? No. So such a transaction only we give a fancy name called what? Mutual. So let's take this example. Sir, A Limited has sold goods to B Limited. A Limited has sold goods to B Limited and it's a credit sale. If it's a credit sale, has A recovered the money or not yet? Not yet. So A will show this as what? Debtor. Correct? No, because money is still recoverable. I've assumed the value to be 1 lakh. So for A Limited, it is a debtors means for B Limited, it will be a creditor. Worth how much? 1 lakh. Fine with it so far. Now people, A Limited and B Limited got merged and they formed a new company called C Limited. A and B got merged and they formed a new company called C Limited, or maybe A took over B. It could be any scenario. It's okay. Fine now. Sir, as long as A is a separate legal company and B is a separate legal company, A can pay B or B can pay A. Now these two companies are legally in existence or gone? Going there. That means who will pay 1 lakh? Who will receive 1 lakh? Tell me. Who will pay 1 lakh? Who will receive 1 lakh? Are two companies there or gone? Gone. Right? But transaction was there. A was showing this as what? Debtor. B is showing this as a creditor in their balance sheet. Correct? Yeah. But these two companies there are gone. Sir, as long as there are two separate legal entities, one can pay the other. But now are these two there or gone again? So hence this one, can you still show it as a debtor and creditor or nullified? Because nobody will pay anybody here. Right? You cannot pay because they are not in existence. So this you'll have to cancel. And that only we refer it as what, sir? Mutual. Fine. Now, will you cancel in A Limited books, B Limited books or C Limited books? C Limited. Because you will have to cancel only when the merger happens. When after amalgamation, one cannot pay the other. So in the new company ka books, in the purchasing company ka books, mutual owings will get cancelled. That's all it is. Yes. Okay, sir, usually mutual owings in our exams will come in 3 forms. One, debtor creditor, or bill receivable, bills payable, loan taken, loan given. So in the books of new company, what we have to do? Show this mutual owings or cancel? Sir, all these are liabilities. Liability has what balance? Credit balance. How do you cancel it? Debit. So basically, liability account you will debit and asset account you will credit. That's all you have to do. So this is another adjustment which can come. These are all common pointers, sir. So mutual owing adjustments, you can see it in purchase method also. You can see it in merger method also. These are all common. Steps are over. These are the broad steps. Now we are discussing some extra adjustments which they usually put it in the questions. Got the concept? Yes. So again, one nutshell mein, what is the takeaway from mutual owings? First of all, mutual owings means what? A transaction happening between purchasing company and selling company. When purchasing company still exists, when selling company is still there, should we have to cancel it or not required? Not required. But when amalgamation happens, whether it is purchase method, merger method, does not matter. When amalgamation happens, are there two companies now or legal existence is lost? Legal existence is lost. So will one pay the other or there is no possibility? There is no possibility of one paying the other company. Hence, we'll have to cancel. So one liability, one asset we need to cancel. To cancel a liability which has credit balance, we debit. To cancel an asset which has debit balance, we credit. So liability account debit to asset account would be the entry that you'll have to pass. Move forward. Bad idea to continue, is it? You're feeling too hungry, is it? Or too angry, is it? Yeah, I'm mostly anger. No? That anger is showing out there. Huh? It's okay. Another 1 hour. just kidding. Okay, 2-3 more concepts and couple of sums we will do. More or less, it should be sorted. Next adjustment, but pay attention. But one thing I repeat, people. Okay, this is something probably if you're new, I'm a big believer in this particular principle of mine. See, to gain something, no certain sacrifice everyone has to do. So don't get bogged down by the small little things that you're doing. See, right now I know that your tummy is giving signals. Your mind is running about breakfast to idli na, vada na, pongala, whatever. Right? But for one idli, you should not compromise one attempt. No. Correct? For one idli, you want to one attempt you want to lose out. Huh? So which is better? It is okay. It's okay. Don't worry. One meal, if you skip, nothing will happen. I am following intermittent fasting for last almost 10 years. Right? Last 10 years. I have only 2 meals a day. And that too, only one cooked meal a day. Rest are all salads, fruits. You see me awake and alive only, no? Fine, no. Right? So it is okay. Nothing will happen. If at all happen is probably you look a little younger than your age. I can vouch for that. Right? Just saying. But on a truth note. So nothing, don't worry about small little thing here, one meal, half an hour, 1 hour late and all. Later is okay. Even if you skip also, it is good only. You know, last, I think, few years back, Nobel Prize was awarded to, I think, Japanese scientist who said 24 hours fasting is the best medicine that you can give it to your body. 21 day of fasting. He suggested water less fasting. Meaning water also you should not consume for 24 hours. It looks tough, but you can do it. Trust me. Initially, it will look like haha and all. I've done it many times. So not a big deal. I think I've gone up to 20 hours without anything. But food, I think I've done many times 24 hours. In fact, monthly once I do it. It helps. I mean, I'm not saying you should do it, but that's your call. Don't faint and all. I say, this fellow told you, I did to, now I'm lying on the road. Don't give me all that. I've been doing it for many years. So I'm just saying that it is okay. But forget about all that. The point is, little bit of sacrifices is absolutely fine. So don't get bogged down by those things. Now, I think the focus for the next 2 months for you should only be on the studies and how to crack the examination. Rest of whatever else is there in your mind, throw it out. All your girlfriends or boyfriends or your parties or your trips or everything can wait. Now it's not the time for that. After you crack your exam, do whatever the hell you want. I'm absolutely for it. I feel you should enjoy life also. There should be a balance. Everything should be there. That is also a phase. This is also a phase. But when you are in this phase, don't think about the other one. Oh, so nice I was. I was going that day in one park. She was holding me. All that mode and all, don't go. Right? Right now, concentrate only on the studies. That's more important to us. There may be a time where you can do that. That I leave it to you to do or not to do. That's your call. I will not interfere. Come back to concept. What is the concept? Stock reserve. Now, what is this stock reserve? Let's look at this first. Let's maybe go ahead with the examples only first and then move forward. Sir, A Limited and B Limited are 2 companies. Now, let's say A Limited has purchased some goods for 10,000. A Limited has purchased some goods for 10,000 and they have sold these goods to B Limited for 15,000. A Limited has purchased these goods for 10 and they sold it to another company called B Limited for what value? 15,000. That means through this transaction, did A Limited make any profit? Yeah, 10,000 worth of goods, they sold it for 15. So they made a profit of 5,000. So far, all okay? Now people, year has ended. 31st March has come. all this goods, no, all this goods is in B Limited ka factory. 100% of this goods is there in B Limited ka factory. Okay. Now you tell me B, whatever goods are lying unsold, that only we call it as closing stock. The goods which are not yet sold, that only which are lying in our factory unsold, that only we refer it as closing stock. Now B Limited will show this closing stock at 10 or 15. Sir, one entity ka selling price is other entity ka purchase price. If A Limited sold for 15 means B Limited purchased for 15. So B Limited is showing the closing stock in their balance sheet at the value of 15,000. Clear again? Are we good? So far, okay. Sir, A Limited now acquired B Limited. A purchased B Limited. A Limited purchased B Limited. What will happen when purchase happens? When A acquires B, what will happen? B Limited ka all the assets and liability now belongs to whom? A Limited. Agreed. Because when you buy another business, that business ka assets and liability now belongs to the purchasing company. So since A Limited purchased B Limited, B Limited ka all assets and liabilities now belongs to A. So far good, because they have agreed that all assets will be taken over. That's the negotiation they've done. So far okay. Now this closing stock also will come back to whom now? A Limited. No problem. Okay. Now there is one small issue over here. What is that issue? Earlier, who had this stock? A Limited. A sold it to whom? B. After amalgamation, again the stock came back to A Limited. Coming back is okay, but it did not come at 10,000. It came back at what price? 15,000. Because B Limited is showing the stock not at 10,000. B is showing the stock at 15,000. So same stock came back to A Limited, but not at 10, but at 15,000. This is a problem. Why? Now, this 15,000 includes an element of profit. How much is that? 5,000. You already learned inventory should be valued at cost or NRV, whichever is lower. Can you value the inventory at selling price, sir? Selling price means profit will be included. Cost price means profit will be excluded. But this 15,000, honestly, touch your heart and tell from A Limited viewpoint, from A ka perspective, is this 15,000 really cost price or cost price is only 10? A purchased the stock in the first place only for how much? But right now this closing stock has come back at what value? 15,000. That means there is an element of profit included in this 15. How much element of profit is that? Yes, sir. Now, is it right for A Limited to show this 5,000 profit in closing stock? Would that be right? Because this goods belong to whom in the first place? A only. So hence, what AS14 says is, this profit element which is included in the closing stock, you will have to eliminate. That profit element only we give a fancy name called what, sir? You can call it as profit element, you can call it as loading element, or you can simply call it as stock reserve. Either ways, can you show this or should you eliminate this? Eliminate. That's all is 1 point formula if you're looking for it. So basically, whatever profit is included in the closing stock, eliminate. And the name through which you eliminate is called as stock. SRO. This is done. Next, sir, that means if you have to eliminate means you need to pass entry, no sir? Yes, of course you need to pass entry. Now, do you think this scenario should only happen in purchase method or it can also come in merger? Merger, because all this would have happened before amalgamation, correct? So this stock reserve is relevant for purchase method also. It is relevant for merger method also. It's an add-on concept, right? So what entry you will pass for eliminating stock reserve depends on the method. Now I think you know this, you will help me out. Sir, first let's take a purchase method. Under purchase method, if it is a loss, what do we call that loss? If it is purchase method, if the purchasing company makes loss, we call that loss as what? Goodwill. So under purchase method, if you get a loss scenario, then the journal entry for stock reserve elimination is loss. We call it as what, sir? Goodwill. So that means the entry you will pass is goodwill account debit to stock reserve. So why stock reserve? If you don't want to use stock reserve, no problem. Directly credit what? Closing stock. Directly credit what? Closing stock. Sir, why, sir? Sir, currently closing stock is shown at what value? 15. Can you show it at 15 or bring it down to cost price? From 15, you'll have to bring it down to 10. You'll have to bring it down to cost price of 10,000. So how much you'll have to reduce closing stock by? 5,000. Closing stock is an asset. Assets have what balance? Debit balance. Here you are increasing or you are reducing. So that means what will you do? You will debit or you will credit? Right? Either you can use stock reserve or directly you can credit closing stock. Fine now people. So credit will be given to that. Debit you will give it to goodwill because purchase method says loss. You use the term called goodwill. So this is the entry you will pass. Yes sir. If you know this, tell me the entry if it is purchase method and if it is profit scenario. What is the entry? Under purchase method, if you get profit scenario, do you call it as goodwill or you call it as capital reserve? So complete the entry for me here. In that case, the entry will be capital reserve account debit. Directly credit can be given to closing stock or you can give it to stock. That's the scenario. Hope this scenario is completely fine. Sir, if you know this, merger method also you can complete the entry for me. Because this concept is only relevant for purchase or also merger. Also merger. So under merger method, tell me. Again, whenever stock reserve comes, you'll ask the question what? Whether it is a purchase method or merger method. Whether it is a profit scenario or a loss scenario. Now, under merger method, if it is a loss. Under merger method, if it is a loss, will you call it as goodwill or adjust it in reserves? Usually which reserve? General reserve. I mean, tell me the entry for stock reserve. General reserve or P&L, whichever reserve you are adjusting, you can use. Usually we use general reserve. General reserve account debit to either directly closing stock or you can credit stock. Fine. Now, this is for merger method under which scenario? Loss scenario. If it is merger method and if it is a profit scenario, then under merger method, profit, will you show it as capital reserve or you will show it as P&L? In that case, the entry will be P&L account debit to stock reserve or closing stock. This is the concept of stock reserve. Again, it is a common concept. It can come under merger method or purchase method. Okay, if you have understood this, I don't think so you need to touch upon any question. You know the entry. It is just that you'll have to fill out the amount. One question will still do with this adjustment, but just say. Move forward, huh? Yes, sir. Once enough, sir. Okay, amalgamation expense. Amalgamation. Sir, amalgamation is not a small act, right? It's a fancy, sophisticated activity. A lot of people are involved. We chartered accounts are also involved. We put a lot of tuna to our client to give fees of 10 lakhs, 15 to charge in crores also. Yeah, it's a big thing. Yeah, for one amalgamation, if you are involved, your life more or less will be set to. But unfortunately, all these assignments, it does not come to individual CA. It usually goes to big fours. So yeah, because fancy activity, you need a lot of manpower. So they usually don't give it to individual practicing CAs or mid-sized firm. Big four grabs all this. No, don't worry. You are all 100 plus people. No, after qualifying, you all 100 people come together and become a new big four or maybe big seven. Yeah, you call it that way. And become rich and compensate me also. Kidney, no. Right? How long I will also teach? I will also settle in life. No. I'm waiting for that one student who becomes a crorepati and gives me so much money that I can say, thank you people. Thank you. Wonderful for your time. One of you will do from this batch. Huh? At least 3-4 are nodding. Others are saying, you give. We will take. Okay. Amalgamation expense. So coming back to the concept. So amalgamation is a sophisticated activity. There will be a lot of expenses that come. Because when you hire a consultant, nobody will work for free. They will always put some bill. Yes, no. So that only we're calling it as what? Amalgamation expense. People, you know the entry for this. You know the entry for this. Now, amalgamation expense will only come for purchase or merger or common. Common. Same as stock reserve. Fill in the blanks. Same as stock reserve previously we discussed. Fill in the blanks. First, what's the first question you'll ask? Purchase method, merger method. Profit scenario, loss scenario. Okay, let's first look at this. Purchase method. Purchase method. Loss scenario. We already saw an internal reconstruction. What is the entry for expense? expense, or rather can I say P&L account debit to bank? Effective entry is P&L account debit to bank. But under purchase method, under loss scenario, we call it as goodwill. So it will not be P&L to bank, rather it will be goodwill account debit to bank. Easy now. This is under purchase method for which scenario? Same purchase method, if you get a profit scenario, profit, what do you call it as? Capital list. So the entry will be capital reserve account debit to bank. Sir, why bank, sir? You're paying an expense, no? So money is going out. When money is going out, bank balance will reduce. Hence credit bank. Is a merger method, fill in the blanks again. Don't look at the screen. Try to recall that way only. Merger method, now it's a loss scenario. In merger method, if it is a loss, will we call that loss as a goodwill or adjusting reserve? Adjusting reserve. So the entry will be reserve account debit to bank. Usually for amalgamation expense, our ICI books use P&L. They don't use general reserve. They have favoritism towards P&L. But in my opinion, even general reserve also can be used. But ICI will pass the entry P&L to bank. This is for which scenario? Loss. For profit scenario, under merger method, if it is profit scenario, will you call it as capital reserve or just P&L? I mean, the entry will be what? P&L account debit to bank. Same like stock reserve, no change there. This also is a common concept, can be seen in quite a few examination questions. Next one. So how many more? This and one more. Conceptually we are done. Question is pending, in case you're wondering. Yeah, next one is statutory reserve. Statutory reserve. Sir, certain reserves are created as per a legal act. Like you may have some gratuity liability created as per gratuity act or whatever. So the question will say, right, there are certain reserves which are created as per income tax act to gratuity act to PF act to whatever. Right. The question will say that reserves, no, selling company has some statutory reserve or some legal reserve, and the adjustment will say that reserve has to be compulsorily taken over and maintained by the purchasing company. What did I say? Reiterate or tell me back at me. Selling company has some legal reserves, that only we calling it as statutory reserve. Now this reserves can purchasing company ignore or they have to compulsorily take it over? Compulsorily take over, because it is not a matter of choice, it is a legal obligation. Fine. So selling company ka one reserve, purchasing company has to compulsorily take over. That we are calling it as what, sir? Statutory reserve. Sir, if purchasing company is taking over one reserve, they have to account it in their books, right? No. Will the reserve directly come in balance sheet or first journal entry? Journal entry. Now, what is the journal entry you'll have to pass? Any guesses? Or tell me for the merger method, it's the easiest. What is the journal entry under merger method for statutory reserves taken over by the purchasing company? Entry required, not required? Entry required, not required? Under merger method, no entry is required. Why? Sir, under merger method, is it really is it business purchase or shuffling? In shuffling, we take over what and all purchasing company will take over? Assets, liabilities and reserves. Reserves of all the reserves of the selling company is already taken over. And that reserve will include also what? That means one separate entry for statutory reserve taken over is required to be passed or not required. Anyway, we have already taken over all reserves. That all reserve will include statutory reserve. Hence, under merger method, for statutory reserve, you don't have to pass any specific journal entry. That's a logic. Okay, G. Yes, G. What about purchase method? Under purchase method, we take over only what? Assets and liabilities. We don't take over reserves because, sir, we have reserve of 1 crore. Will you take over? ArivuPro, let's say, I'm just saying, don't go out and spread rumors. They have 1 crore reserve and just giving you blurting out some numbers. That's all. Let's say ArivuPro has 1 crore reserves. General reserve, we have 1 crore. You purchased ArivuPro. What will you do with that 1 crore general reserve? Nothing, no. Sir, you can take over assets. You can settle liability. What will you do with share capital and what will you do with reserves? Nothing. So hence, if it is an actual business purchase, you only take over what? If it's an actual business purchase, you only take over Here I've written that also. If it's actual business purchase, you only take over assets outside liabilities. If it is merger method, it is just anyway reshuffling. In reshuffling, you can also take over reserves. Fine, people. So again, what is it? Fine. One takeaway I'm saying. Under purchase method, what and all will be taken over? Assets, liabilities. Under merger method, assets, liability, and reserves in surplus. Correct? Now, there is one reserve which legally purchasing company is obligated to take over. That is called as what, sir? Statutory reserve. But under purchase method, will we take over any reserves or we will not take over? We will not take over, right? But this reserve can we ignore or we have to compulsorily take over? We have to take over because legal obligation. Now, under purchase method for statutory reserve, will any entry come? Yes. Reserve has what balance? Credit balance. Now, purchasing company has to take this reserve and show in their balance sheet. The purchasing company has to take this reserve and show it in their balance sheet. Where will you show reserve and balance sheet? Asset side or liability side? That means reserve has what balance? Credit balance, right? So hence you will credit what reserve? Why statutory reserve? Because that is the reserve you are taking over. So you will credit whichever statutory question will specify the statutory reserve, you will take over that. And value also will be given to you in the question. 1 lakh, 5 lakh, whatever. Entry means you have to debit also. Debit will be given to one dummy here called amalgamation adjustment reserve account. Fine, people. Amalgamation adjustment reserve account. So statutory reserve will come in balance sheet under reserves in surplus. What happens to amalgamation adjustment reserve, sir? That will also come in balance sheet only. That will also come in balance sheet under where? Reserves in surplus only. But this reserve is having credit balance or you debited it. Since you debited this reserve will have a debit balance. So effectively what will happen? This reserve will have a debit balance. This reserve will have a credit balance. Essentially they will get nullified. Because under purchase method, any which way we don't take over the reserves. So in a way you are taking over, but in a way you are not taking over also. Because you are showing one reserve with credit balance, you are showing another reserve with debit balance. Both will get squashed off or nullified. Since we have a legal obligation, we have to show this. But effect in balance sheet is there or 0. If this statutory reserve is 1 lakh, means this amalgamation adjustment also will have 1 lakh. This 1 lakh will have debit balance, this 1 lakh will have credit. Effectively it will become 0 by passing this it. Yes, sir, people. Minute or move on? Last concept. Can we look at this? So far what and all we have seen is what to be done in the books of purchasing company, right? Now next is, there is only purchasing company here or also selling company? So what should be done in the books of selling company is what we are reviewing. Selling company legally in existence or closed? Sir, you have done all this in your 11th PUC only. Partnership firm you have done. When a partnership firm gets dissolved, you have done dissolution of partnership firms. What you used to prepare? Realization account, right? Here also same thing. Selling company, since they are shutting down, they prepare one account called realization account. You just have to prepare realization account. Sometimes instead of asking ledger accounts, they ask you journal entry. That is ICA ka favorite. Because ledger aram se you will put up because you have practice. Journals, you will have to visualize the ledger and bring it back to journal format. But ICI plays around. Sometimes they ask ledger, sometimes they ask journal, their choice. But we will review this as a ledger. One by one. Selling company, they are shut down. If the company is shutting down, can any ledger have a balance or every single ledger should be closed? Every single ledger account should be closed. So to close a few ledgers accounts only, we prepare something called realization account. First step. In fact, I had given you notes also. Some 7-8 points I had given you in class about the realization steps. I'll just probably tell it now or probably we'll review it quickly. First, selling company has assets. Assets ka ledger. Keep it or close it? Close it. Asset has what balance? Debit balance. How do you close? Credit. How are you closing this asset ka ledger? Through opening what account? Realization. So tell me the entry. Realization account debit to assets. All assets have debit balance. To close we will credit. Right? So the entry will be realization account debit to assets. I've written sundry assets because you will not have one asset, you will have many assets. For the sake of format, I've just written sundry there. Sundry means combination of many. Okay, now. Sir, which value, sir? Agreed value, no? Book value, no? Sir, selling company is shut down. Selling company is getting shut down. Will they worry about market value? Sir, whatever value you are showing in your books, that you need to cancel. Hence, all this entry will be passed with BV, not here Hindi ka BV. This is BV here stands for book value. So, realization account debit to assets account is first entry. By passing this, all the assets ka ledger balance will get closed. Only assets you need to close or also liability. Liability, you throw back the entry for me, sir. Liability has what balance? Credit balance. How do you cancel? Debit. So the entry will be liabilities account debit to realization account. So when you post that entry, the entry is liability account debit to realization. So when you post this entry in realization ledger, it will come as what? By sundry liability. Agreed value or book value. Since the intention is to close, we will only worry about the book value. By passing these two, what will happen? All assets closed, all liabilities closed. Sorted out. Okay. Next. Sir, selling company shut down at free of cost or they are asking some compensation? Selling company sold itself for certain money. That money or settlement only we give a fancy name. What does that mean? PC, purchase consideration. So selling company will ignore it or collect it. From whom? Purchasing company. That means for a selling company, purchasing company indirectly becomes a debtor because selling company has to collect some PC from purchasing company. Agreed? Debtors will have credit balance or debit balance. So what is the entry? You can't say debtors because debtors is a term used for selling the goods. Here did we sell the goods or we sold whole company? Whole company. And we have to recover money from purchasing company. So the entry will be purchasing company account debit because we have to recover money from them. And all this will be routed through which account? Realization. So that means when the entry is purchasing company account debit to realization account. So when you post that in realization ledger, it will come as what, sir? By purchasing company. And what will we recover from this purchasing company? PC. You already calculated PC. Same brings in here. Done now. And if you remember your 11th grade and all, you used to write buyback. For assets sold, you used to write bank account debit to realization. Because in dissolution of partnership firm, what used to happen is, we used to shut down partnership firm and sell each assets individually and settle each liabilities individually. Here, are we doing that or we sold the whole company? We sold the whole company. So individual settlement will not come, rather it's a wholesome settlement called what? PC. Hence, instead of buy bank, we will say buy purchasing company, which is a PC recoverable, this much amount. Yes, sir, Saru. Sir, is it compulsory that every asset of the selling company has to be taken over by the purchasing company or negotiation? Negotiation. Let's say one asset selling company had, purchasing company told, I don't want that. Let's say one machinery, it has become very old. Purchasing company told, you keep it. I don't want it. I don't want it. Now, selling company, can they keep that machinery ka ledger open or close? Is it open or already closed here? We already passed the entry realization account debit to asset account. So that machinery ledger is closed. But physically that asset is present? No. Correct. Will the selling company keep it or sell it? Now they will sell it. Because is the purchasing company taking over that machinery or not taking over? So for those assets which the purchasing company has not taken over, selling company will sell it individually. And now it becomes your 11th grade. When an asset is sold individually, what entry will pass? Bank account debit to realization account. So you'll pass the entry, you'll post it as by bank. This may be there in the question, it may not be there. Some adjustment may they give this, some they may not give. Understood? Once more, paka, confidence is little low. Tell me once again, what is this adjustment? What is this adjustment coming on? Selling company has one, in my specific example, selling company has one machinery. Was that machinery taken over by the purchasing company or not taken over? Not taken over, right? Is that machinery ka ledger open or already closed? You already passed the entry realization account debit to asset account. So the machinery ka ledger is already closed. But physically it is closed or physically it is still present. Can you see that machinery still? Yes. Will the selling company keep that machinery idle like that, or they will sell it off now? They will sell it off and they will recover some money. Individual recovery they are doing. Hence the entry is don't pass now. When you sell a machinery, what entry you will pass? Normally when you sell an asset, machinery, what entry you will pass? Bank to machinery. Here we can't pass. Why? Sir, machinery ledger is already closed. If you write bank to machinery, now machinery ka ledger will come in with a credit balance. Since machinery ka ledger is already closed, and when that asset is sold, we route it through what? Realization account. Hence the entry becomes bank account debit to realization. This is the fund. Okay. Same goes for liabilities also. If any liability is not taken over, so suppose selling company has a creditor worth 50,000. Selling company has a creditor worth how much? 50,000. Purchasing company told, I don't need that creditor. I will not pay that creditor. Can selling company tell that creditor, purchasing company didn't take over, so go in there for you? That creditor will come with porke, broomstick only. Yes or no? Because the amalgamation is a headache between purchasing company and selling company. What will the creditor tell? You do whatever, give me my money. Is purchasing company taking over this liability or not taking over? Not taking over. So what should the selling company do? Pay off this liability. What's the journal entry for creditors paid? Creditors to bank. But is creditor ka ledger open or it's already closed? All the liability ka ledger is already closed. So can you pass the entry creditors to bank or route it? Route it through which account? Realization. So instead of creditors to bank, the entry will be realization account debit to bank. This is for what? Some liabilities which are not taken over but settled by whom? Selling companies. Again, this may be there in question ka adjustment or may not be there. It's a format, so I brought it as much as possible. Yes, Saru. Next, amalgamation expense. Sir, we already passed the entry for amalgamation expense. Yes, we passed. But under which method? Purchase method, merger method. Method is relevant for the purchasing company, selling company, which company? Method is only relevant for the purchasing company. Sir, is it necessary amalgamation expense should be compulsorily incurred or spent by purchasing company only, or it could be spent by selling company also? It's a negotiation, right? Anyone can incur that expenditure. Suppose selling company incurred that amalgamation expense or realization expense as you used to call it. What entry will pass? What is the entry for expense? P&L to bank. For one expense, you want to open whole P&L. No. So instead of P&L, again it is routed through which account? So if any expense, amalgamation expense or dissolution expense or realization expense, if it is spent by the selling company, the entry will be realization account debit to bank account. That's what I've written over here. Liquidation expense I've called. Done. Sometimes what happens, we have done this adjustment in class also. First selling company will pay the expense. Later they will recover from purchasing company. First selling company will pay this expense and later they will recover. When expense is incurred, what is the entry? Realization to bank. When recovery happens, ulta. Bank account debit to realization. This is for what? Reimbursement of liquidation expense. May be there, may not be there. Basically, ulta entry. For expense, it is realization to bank means for the reimbursement or taking it back, the entry will be bank to realization account. Just give you a minute, observe that. I know it's too much to take in, especially if you're doing it for the first time. But if you are a regular student, this and all is literally nothing. We have done like I think 5-6 questions on this. In fact, in every questions we used to repeat this as a thing. Yeah. But anyways, I'll not go into who is regular, who is the not regular and all. Not the intention. Sir, this one I will tell later. Leave this. I have one question I picked where this adjustment will get covered. For the time being, leave this. Now, the intention of preparing realization account, one is to close down ledgers and finally to know whether selling company made a profit or they made a loss. That only we call it, or we used to call it, or we still call it as realization profit or realization loss. In your partnership accounts we used to prepare, realization profit or loss, you used to transfer it to partner's capital account or current account depending on the method. Yes or no? Because partners were the owners. Here what you will do? Same realization profit or loss, you will transfer it to owner. So which owner? Preference shareholder or equity shareholder? Who bears all this risk? Preference shareholder will take risk or equity shareholder? Hence, realization profit or realization loss will be transferred to equity shareholders. That you don't have to calculate, it becomes your balancing figure. Okay, now. So, how to know whether it is profit or loss, sir? Simple, sir. Realization account is also like your trading P&L. If balancing figure comes on this side, see, visualize your trading P&L. Credit side is all for your incomes. If you remember sales, so imagine trading account. Sales came on which side? Debit or credit? Credit. All income came on which side? Credit side. All expense came on the debit side. If this side is more than this, means it becomes a balancing figure as a profit. So basically balancing figure comes on the debit side, means it's a case of a realization profit. If it comes on the credit side, it becomes realization loss. MCQ pattern, no. Anything and everything can be asked. Okay, so you need to be conceptually clear here, because 30 marks ICI can play around. You can also play around. Heads means option A, tails means option B. Okay, coin go in the means option C. you can do no, literally 30 marks in your pocket, sir. There is no negative. Huh? She's asking for D. Huh? I mean, who knows? You click all D. It's okay. D might work out for you. She's just saying 30 marks. ICI also can play around. You also have the choice, because there is no negative. Bendas, you will also mark no. So what if stars are in your favor? You clicked, chumma you put full 30 marks, swaha you did. That means another 10 more marks if you pick it from descriptive. From CA intermediate, you will automatically become CA final. So luck works both ways. So do some good karmas in your life. Okay, don't wish bad for your friends, so don't be jealous and all now. Yeah, it's time to do good karmas. Okay. Yeah, show good karma by showing more energy here now. Don't disappoint the person sitting here now. A good karma, I'll give you some. Anyways. Okay, people. So this is your realization account ka drama. Yes, sir. Yes, sir. Got it, sir. I'll tell you one checkpoint to know whether you have done wrong or right. You have one checkpoint which I have anyway dictated in class. Sir, every single ledger account should be closed. Now, one more ledger is open called equity shareholders. 6 components you have to transfer it to equity shareholders account, and that particular account should get balanced. Meaning debit side total, credit side total should match. It doesn't match means Brahaspati, you have done something wrong. Recheck. That way you will get to know that whether you are in the right direction or wrong. 6 components. If you want it, you don't actually need to mug it up. But anyways, if you do enough number of questions, it will get registered in your mind. What are those 6 components? I've written it here. Forget that, what I have written. You visualize. Balance sheet, give me the inside of the components ka heading. What are the headings you will give? Equity and liabilities. Under that, shareholders funds. Under that, okay, heading is what? Shareholders funds. Under shareholders funds, you show 2 things. What are those? Share capital, reserves and surplus. That means 2 components belongs to equity shareholders. What are those? Equity share capital, reserves and surplus. Of the 6, 2 is sorted. Equity share capital, reserves and surplus. One more which is kind of outdated now, mostly you will not get, but out of the blue sometimes it comes, called preliminary expense or deferred revenue expenditure. Okay. So what is this, sir? Sir, preliminary expense, deferred revenue expenditure means an expense which is not yet transferred to P&L. An expense which is not yet transferred to P&L. But eventually where this will go? Eventually this will also go where? P&L. And P&L belongs to whom? Equity shareholders. So if at all you see this in the question, in the balance sheet of the question, this also you transfer it where? Equity shareholders account. Okay, let's do it with entries. Okay, first tell me this entries. Equity share capital has what balance? Credit balance. This belongs to whom? Equity share holders. What entry you will pass? Equity share capital has credit balance. To cancel, we'll have to debit. So the entry will be equity share capital account debit to what? To equity share holders account. Now, when you prepare equity shareholders ka ledger, what will be the posting? When you open equity shareholders ka ledger, you will post this entry where? You will post it as by equity share capital. And now, yes, sir. Now, reserves and surplus has what balance? Credit balance. Reserves belongs to whom? Again, equity shareholders. So, what entry you will pass? Reserves and surplus account debit to equity shareholder account. When you post this entry in equity shareholder account, what will you post it as? By reserves and surplus. Two components are done with the entries. Yes. Third component, what is that? Preliminary expense, deferred revenue expense, or miscellaneous expenditure, whatever. If you are confused about the balance, go back to your rule. Nominal account rule says expenses should be debited. So all this will have what balance? All this expense will have a what balance? Debit balance, right? You have to cancel it. Something which has debit balance, how do you cancel? Credit. Where are you transferring this to? Equity shareholders. So what is the entry you will pass? Equity shareholders account debit to these respective expense account. When you post this in your equity shareholders ledger, you will post it as to miscellaneous expenditure or preliminary, whatever. Third component. Yes, G. Sir, shareholders will, okay, 1 minute. Okay, let's go one step back. Realization account we prepared. What did we get from realization account? Realization profit or realization loss? Who will take that realization profit or loss? Equity shareholders. So that will come here. If it's realization profit here, if it's realization loss, that's it. Because anyway, that came from realization account itself. Yes, sir. Fourth component sorted. Fifth one. Equity shareholders will sacrifice their shares at free of cost or they will get PC. PC. What's the journal entry for cash paid to equity shareholders? What is the journal entry for cash paid to equity shareholders? Equity shareholders to cash. Suppose instead of paying cash, they received a new company ka equity shares. Possible, no? PC can be settled in cash. It can be settled in check. It could be settled through equity shares, preference shares, debentures, whatever. If you're paying cash to equity shareholders, the entry will be equity shareholders to cash or bank. Suppose they get new company ka equity shares. What entry you will pass? Equity shareholders account debit. Don't write equity share capital, Guru. They received some other company ka shares as an investment. Right? So, this selling company is not issuing the shares. Who issued the shares? New company. You are passing all these ledgers in whose books? So? Selling company books. Correct? No, selling company is doing all this harkate, drama. Correct? So the entry will be what? Equity shareholders account debit to equity shares of the new company. Depending on this, this is basically PC. Done now. Yes, sir. The last component is, sir, after doing all this drama, suppose selling company still has 10,000 rupees extra cash. Selling company still has how much cash? 10,000. Will they tear it off? That Gandhi note, they will tear it off. They will burn it. They will give it to you and me. No, whom will they give it to? Equity shareholders. So after doing all this, if the selling company has any surplus cash, that surplus cash also will be transferred to equity shareholders. So the entry will be equity shareholders to bank. When you post, I'm not saying all the 6 will come in your question, but these are the maximum adjustments that can come in your equity shareholders account. When you transfer all this, when you consider all the 6 adjustments, debit side total and credit side total should match. If it doesn't match, sorry boss, review again. Yes, that's all is the final takeaway of this. This one you leave with some question adjustments. With this, conceptually, we have done amalgamation. That's all. Very, very easy. Yes, no. What else is there? Few things. Correct, no. 5 minutes, we'll recap and do a couple of questions and then wind up for the break. It's okay, no issues. I said one, we are taking one for the day today. Tomorrow we'll plan a little bit. Maybe I'll take up a little shorter topic so that you get the breaks early. Okay, today it's on me, so apologies for that. I think it's okay, no? Manage. Topic name: amalgamation of companies. Standard, which standard backs this? AS14. AS14 covers both sort of amalgamations, meaning one company taking over another company, 2 companies merging and forming a new company. For accounting purpose, we have 2 methods. Purchase method. If you want me to show the chart books, okay, you want to make some quick notes or something? If you want, as and when I tell, I'll show. Okay, fine. All right. For accounting purpose, we have two methods: purchase method, merger method. Right? Sometimes the question will mention the method, sometimes they will not. If they have mentioned the method, we don't have to do any, we don't have to take any more load. Simply solve. If they don't mention the method, test it out. How? For merger method, there are 5, and all the 5 should be satisfied. What are those? All assets and liabilities of the selling company should be taken over, and they should be taken over at book value. Equity shareholders who are owning 90% shares in selling company should also become shareholders in the new company. Percentage in the new company could be whatever. PC payable to the equity shareholders of the selling company has to be in equity shares only. Other than new equity shares, you cannot give anything as PC. Otherwise, merger ka condition will get violated. Fifth one, business of the selling company, you should continue to, you should have an intention to carry on. How long? Not specified. Now, if you're talking about purchase method, there are certain steps under purchase method. Purchase method, is it reshuffling or an actual business purchase? It's an actual business purchase. So in your purchase method, first you can calculate net assets. How do you calculate net assets? Assets, all assets or assets taken over? Assets taken over at book value or agreed value? Assets taken over at agreed value minus liabilities taken over at agreed value. That way you will get net assets. Second one, calculate purchase consideration. Purchase consideration means settlement value. Who will pay settlement value? Purchasing company. To whom? Owners of the selling company. Whatever is paid to the owners of selling company is referred to as PC. And who are the owners of selling company? Equity shareholders and preference shareholders. So compare PC with net assets. Net asset is the worth of the company. If PC is more than the worth, that means purchasing company made a loss. That loss we call it as goodwill. If PC is less than the net assets, that means purchasing company made a profit. Capital profit to be transferred off to capital reserve. Perfect. Next, merger method. In merger method, what do we do? First step is PC. Merger method, is it really a business purchase or shuffling? It's just a reshuffling. In reshuffling, we need market value or not required? Everything will happen at book value. Okay. One primary distinction is in purchase method, only assets and liabilities will be taken over. But in merger method, assets, liability and reserves in surplus of the selling company will be taken over because it is just a reshuffling or a reorganization, and everything will be taken over at book value only. So the only thing not taken over under merger method is what? Paid up capital. So that only you compare it with PC, and the difference becomes profit or loss. If PC, in a way for your reference, you can think paid up capital is like a worth. If PC is greater than the worth, then purchasing company made a loss. Here loss we call it as goodwill or adjust. Where? Reserve. Since anyway we are taking over the reserves, adjust it in the reserve. Usually that adjustment happens in general reserve. If PC is lesser than the paid up capital, then it's a profit, right? Okay, due to some clash of provisions, we don't transfer it to capital reserve, we transfer this profit to P&L only. The more clarity over that, you will get it in your CA final, Ind AS 103 topic. Let's not go there for the time being. Too much time. Okay, yeah, leave that out. Next, we discuss something called mutual owings. Mutual owings means what? A transaction happening between a purchasing company and a selling company. Sir, as long as there are two separate legal entities, one can pay the other. But in amalgamation, what will happen? One will lose its existence, or both of them may become merged into a new company. So both of them may lose their existence. So hence, since they are losing their existence, one cannot pay the other because other is not there. Hence, mutual owing should be cancelled. Where? After amalgamation, in the books of the new company or purchasing company, mutual owing should be cancelled. Mutual owings usually will come in three forms. What are those? Debtor, creditor, bill receivable, bills payable, loan taken, loan paid. So that you need to cancel. One liability and one asset you need to cancel. Liability has a credit balance, to cancel we debit. Asset has a debit balance, to cancel we credit. Okay. Next we saw stock reserve. Stock reserve means what? Stock reserve simply means profit element included in closing stock. How will this happen? Because one company, either purchasing company or selling company, has sold the goods to other company, and sales has happened at cost price or selling price. Since the sale has happened at selling price, some profit element will included in what? closing stock. And after this amalgamation, the same closing stock will come back to what? A Limited. But it will not come back at cost price, but rather it will come back at selling price. So some profit element will be by default included in closing stock, which you cannot show. Because if you show, it looks like I made profit from myself. Because this goods, in this example, this goods was with whom first? A Limited only. After amalgamation, still the goods came back to whom? A Limited. So if you show this profit, it will look like A Limited made a profit from themselves. Hence, that will not hold good. So you need to eliminate. That only we refer to as what's a concept, we call it as stock reserve. Okay. Now stock reserve ka elimination is based on the method. It is dependent on the case. If it is purchase method and if it's a loss, if it is a purchase method and if it is a loss, what is the journal entry for stock reserve elimination? Goodwill account debit, you can credit stock reserve or you can directly credit closing stock, your choice. Usually ICA will pass stock reserve. Will not credit closing stock, but you can use closing stock also. Under purchase method, if it's a profit scenario, then capital reserve account debit to closing stock or stock. If it is merger method and if it's a loss, under merger method, loss we don't call it as goodwill, we adjust it in reserve. So the entry will be reserve account. Usually P&L is what we use, P&L to stock reserve. Profit, same, loss, profit scenario also, the entry will be same, P&L account debit to stock reserve. Yes, Ajay. Next, amalgamation expense. Amalgamation expense incurred by which company? No, selling company. This first we saw on the purchasing company. If purchasing company pays amalgamation expense, then first you need to determine whether it is a purchase method or merger method, and it's a profit case or a loss case. If it is purchase method and if it's a loss scenario, what is the entry? For the expense paid, it will be goodwill to bank. Same amalgamation expense ka entry under purchase method for profit scenario will be capital reserve to bank. If it's a merger method, for profit you will pass the entry P&L to bank. For loss also, usually you can write reserve to bank, but usually I say uses which reserve for this? P&L itself is what they prioritize. Next, the statutory reserve. Sir, under merger method, is there any journal entry required for statutory reserve taken over? No. Why? Because under merger method, anyway, all the reserves are already taken over. This one more reserve ka entry not required. So merger mein no entry required. But under purchase method, we only take over, purchasing company only takes over assets and liability. But this one reserve can we ignore or we have legal obligation? We have legal obligation to take over. Hence we pass one entry. What is that? Amalgamation adjustment account debit to statutory reserve. This also will come in reserves in surplus only. This also will come in reserves in surplus only. This will come with the debit balance. This will come with credit balance. In a way, they will get knocked off. That means even if I don't consider my balance sheet will tally, no sir. Yeah, it will. But you will lose 2 marks. Because the examiner will be looking for this adjustment. Balance sheet will match. But 2 marks going down. So pass. All the drama in the books of purchasing company. Next drama in the books of selling company. Selling company full chillo like you people now. Aram se chilling. Yeah? Selling company ka only worry is to close down all the ledgers. To facilitate this or to make this happen, they open one account. What account? Realization account. First, they will close all the assets. What entry? Asset has debit balance. To cancel, we will credit. So the entry will be realization to asset. By passing this entry, all the assets will be damaru. Liabilities. Liability has credit balance. To cancel, they will debit. So the entry is all the liabilities account debit to realization. By passing this, liability is also damaru. Selling company will sell itself at free of cost or they will recover PC. So that means the purchasing company indirectly becomes a debtor. So the entry will be what? Purchasing company account debit to realization. That will be posted there. Then there may be certain assets which the purchasing company may not take over, but asset is physically present. Will the selling company keep that asset or sell it? What's the journal entry for asset sold? For asset sold, we can't pass the entry bank to machinery because machinery ka ledger is already closed. Hence, we route it through which account? Realization. So the entry will be bank to realization. If liability is not taken over and settled, the entry will be realization account debit to bank. Fine. If amalgamation expense is incurred by the selling company, then the entry will be instead of P&L to bank, for one expense, we don't want to open whole P&L. Hence, we route it through which account? Realization itself. So for amalgamation expense, it will be realization to bank. Later, if we recover this expense from purchasing company, the entry will be ulta, bank to realization. any balancing figure in realization account is realization profit or realization loss to be transferred to whose account? The owner who actually bears the risk, which in this case is equity share holders. Last 6 checkpoints. Transfer 6 things to equity shareholders account to balance it. What are those? Equity share capital, all the reserves in surplus, preliminary expense, realization profit or loss, PC, surplus cash. After passing this also, compulsorily it should match, or if it doesn't match, review once again. Somewhere you have done something wrong. That's all is a concept thing of amalgamation. Her question. What's your name, ma? Sorry, I think you mentioned. Now, Manasa is saying, sir, selling company ka cash and bank balance, won't it be taken over by the purchasing company? That depends on negotiation. If selling company ka cash and bank balance is taken over, great. That's okay. You just transfer that cash and bank balance to realization account and we are done, right? But selling company can also tell the purchasing company, I need money to pay my realization expense, so I will not give you my cash balance. It's a negotiation. It can be taken over, it may not be taken over. Question will specify that. So based on that, you do. If it is not taken over, then the surplus cash will be given to equity share. If it is taken over, then purchasing company will take it and show it in their books. That's that. Both the scenarios are permissible depending on the question.
Some questions get silence.
If the question does not specify what to do, I think I told you this in class. Sir, if question does not say whether asset is taken over or not taken over, always assume that it is taken over at book value. If it is silent scenario, I think might have given a note in the regular class. I don't remember. Okay, no problem. Having sorted, is it sorted? Anything else? Little louder, sir. Stock reserve, where it will come in balance sheet. Stock reserve, you will reduce it from the closing stock. That's the reason I said you can directly use closing stock in the entry, or you can use stock reserve. If you are using stock reserve in the entry, that stock reserve will not come in the balance sheet under reserves and surplus. It is reduced from the closing stock, because stock reserve means profit included in the closing stock, which we need to eliminate. Okay, so both are acceptable. Anything more? No. The same breakfast, sir. Another 20 minutes for 2 questions. That's all. I've taken 2 questions and more or less it will cover same concept and we are done. Okay. Yeah, that's it. 20 minutes. See, I said 1.5 hours. So more or less I passed. Okay. But half an hour here and there it will go. That's okay. Question after break, you'll also not remember. I'll also not remember. We'll finish and then we'll do it. 20 minutes. That's all. Same thing. Whatever we have done, quick review. Just to have, or if you feel I've got it, I'll end the recording and tata. Or just 2 questions. 2 questions is okay. Just to revise the concepts we have taken. I think we'll do it in the interest of other audience. Sir, 2 companies are there. These are study material questions only. Hari and Vayu. Balance sheet they have given. As I have told a balance sheet to Chote. They will give you one dump of balance sheet with notes to accounts. The only thing you need to probably be little specific is what is the face value of equity shares and preference shares. I think in this case, both are what? No, equity share I think is 10. Preference shares of both the company ka face value is 100. So let's keep it there. Other things are okay. Directly let's dive into the adjustments. Pay attention to this. Quite easy only. It's a repetitive one just to get our concepts little more clarified or have a better understanding over them. They were given 2 companies, Hari and Vayu. Read the heading. Hari absorbs Vayu. Hari is taking over Vayu. So Hari becomes your purchasing company. Vayu becomes your selling company. Easy. First identify who is the purchaser, who is the seller. Some terms have been agreed upon for this business purchase. First term. 10. I think one concept I didn't tell. I'll call it out here. 10% preference shareholders are to be paid at 10% premium by the issue of 9% preference shares of Hari. I'll read that line once again for you. 10% preference shareholders, stop there. Who will get compensated? Purchasing company ka owners or selling company ka owners? Who will get settlement? Who will get PC? Purchasing company ka owners or selling company? Purchasing company will pay to the owners of the selling company. Here, who is the purchaser? Hurry. Who is the seller? Why? They're talking about equity shareholders or preference shareholders. So, selling company ka preference share capital is how much? 1. Correct now? Selling company ka preference share capital is 1 lakh. But, is the purchasing company paying 1 lakh, same 1 lakh or 10% premium? Read this line. 10% preference shareholders. See, this is the 10% preference shareholders that they're talking about. Are to be paid at 10% premium. Premium means lower or higher value. So instead of paying 1 lakh, we have paid 10% extra. How much is that? So bonanza, bumper for preference shareholders. Yes, no. Instead of getting 1 lakh, they will get 1 lakh 10,000 as a settlement or as PC. Agreed. And how are they getting this 110? Through cash? No. By the issue of what? 9% preference shares of Hari Limited. So, Hari Limited, the purchaser is giving what, sir? 1 lakh 10,000 worth of new preference shares as PC. To whom? Equity shareholders or preference shareholders? Preference shareholders. Any problem in this? Any problem in this or okay? Again, PC ka definition, you tell me, what is PC? Amount paid by the purchasing company to the owners of the selling company. This 1 lakh 10,000 was given to whom? Preference shareholders of the selling company. So will this form part of PC? Yes. Because they are preference shareholders are the owners of the company. To one kind of owner called preference shareholders, we paid 1 lakh 10,000. So far, okay. Next, goodwill of Vayu Limited. Hang on. Go back to the balance sheet. In your main balance sheet, are you seeing any goodwill? See, they have prepared note number 5 for intangible asset. Come to note number 5. Goodwill. How much is the goodwill? 25,000. But is this taken over at 25 or it was valued at 50? Sir, one thing to pakka. One thing I'm freezed. What is it? Book value is 25. Book value is 25. But we have valued it at 50. That means, is the asset taken over at book value or agreed value? In merger method, you have to compulsorily take it over at book value. Here, asset got revalued. Even if one asset gets revalued, it is not merger method. It automatically becomes what? Because asset is not taken over at book. That's the conditions for us. If they don't specify which method, I think I've already got the clue as to what method is this. Yes, sir. Same thing goes for building. Building got revalued at what? 150. But book value of the building is only 1 lakh. Book value is 1 lakh. Agreed value is 150. Machinery. Book value is 150. It's taken over at 160. So many assets are getting revalued. So obviously it is a purchase method. Inventory are taken over at 10% lesser than book value. Okay. Provision for doubtful debts. Sir, provision for doubtful debts, you will make it on what? Debtors. So when you make a provision, that means you are taking debtors at book value or lower than book value. Lower. Provision for doubtful debt means that debtor may not pay, right? So that means you will recover less from debtors. So indirectly they are saying debtors is not taken over at book value, but 7.5% lower. Okay. Equity shareholders of Vayu Limited will be issued. This line is the important one. Read this line once again. Equity, sir, Vayu is which company? Selling company. Equity shareholders of the selling company, that is Vayu, will be issued what? Necessary equity shares at 5% premium. Did they say how much or necessary? Necessary. That means, do you know, sir, what you give it to the equity shareholders of selling company is also PC. PC means what you give it to the owners of the selling company. What you gave it to the preference shareholders, clearly you know. How much is that? 1,10,000. But what you are paying to equity shareholders is given or missing. Because they use the word what? Necessary. That means PC is specified in the question or it is missing. PC is missing. Understood that? And we used to have a saying in this class. I used to say, when PC is missing, anybody remembers? Perfect. When PC is missing, net asset only becomes your PC. And I have written in the chart book, maybe I missed when I'm explaining it. Here, check. If nothing is mentioned in the question about PC, then net asset itself will become PC. Why? It's very simple. Sir, suppose I have 10 lakh cash I have 10 lakh cash. I have to pay a creditor 2 lakh rupees. I have how much cash with me? 10 lakh. How much I have to pay the creditor? 2 lakh. Can you tell me how much is my net worth? How much is my net worth? I have asset worth 10 lakh. I have liabilities worth 2 lakh. That means net mein, what is remaining with me? 8. That means what is this? Net worth. But this is also net assets only, no? Because how do you calculate net assets? Assets minus liability. So hence we say, like, if nothing is specified to you in the question, calculate net assets, and that net assets only straight away will become what, sir? PC. In fact, I used to give you watch example if you remember in the class, but anyway, I'll not go there. Okay with this. All right. This is sorted. Okay. Now, what is the requirement is they are asking to prepare necessary ledger account to close the books of Vayu. Selling company ka ledger you need to close. And acquisition entries in the books of Hari. Hari is a purchasing company. In purchasing company books, they are asking you to pass journal entry. Two things. Journal entries in the books of purchasing company and ledger accounts in the books of selling company. Okay. One by one. Which method? Quickly tell. Which method? All of you, full attention. Which method? Purchase method. Purchase method ka steps quickly tell me. Calculate purchase consideration. Calculate net assets. Compare. Accordingly, you will get goodwill or capital. Can we do that? In this problem, PC given or missing? Missing. How did we conclude that? Because they said equity shareholders of selling company will be issued necessary. How much is necessary is given? No. That we have to find. So that means clearly PC is missing. When PC is missing, we have a very straightforward approach. What is that? Net assets and PC will be same. Okay? And now go back. How do you calculate net assets? Throw back at me. How do you calculate net assets? Remember, not merger method. It is a purchase method. And from that context, tell me what is net assets? Assets taken over at agreed value minus outside liabilities taken over at agreed value. Okay, take your calculator. Tuck. We'll do it and cross check immediately. Okay. First assets, an adjustment they've given. Goodwill was taken over at what value? No. I need this value or value given in adjustment. First you tell me. I need the value given in balance sheet or the value given in adjustment. Sir, the value given in balance sheet is book value. For net asset calculation, we take book value or agreed value. Agreed. So what is the agreed value of goodwill? 50. Take your calculator, punch in 50. Building was taken over at what value? 150. Add 150. Machinery taken over at what value? 160. So we covered what, sir? Goodwill over, machinery over, land building over. Correct? Are these three the only assets? Plant and machinery over, intangible assets over. We have inventory at 175. Was inventory taken over at 175 or 10% lesser? Inventory ka book value is 175, but it was taken over at 10% lower. So 1,75,000 minus 10% is 1,67,000. 1,57,500. Add 157,500 to your net asset calculation. Okay, now all of you are getting it. All right, next. Provision for doubtful debts is made on what? Debtors. How much provision you are making? 7.5%. What is the meaning of this? Are you taking over debtors at book value or 7.5% lower? Lower. What is debtor ka value? 1 lakh. That means are you taking it over at 1 lakh or 7.5% less? So that will be 92. Yes, Aji. Every value is okay. Now there is one more asset called what? Cash. Manasa's point now. We read the whole question. They did not specify whether cash is taken over or not taken over. What is the assumption we make? It is taken over at what value? Book value. So add 20,000 to that. How much are you getting? This is the asset. They've done a separate calculation. I'm quickly showing you. Okay. But you added only what? You added only what? We want assets or we want net assets? How do you get net assets? From the assets taken over at agreed value, you have to reduce liabilities taken over at agreed value. Now come back to the balance sheet, which is a liability. Long-term provision, they have made note number 3. Come to note number 3. What is that note number 3? Gratuity fund. You'll have to pay some gratuity. That is also a liability, right? If they have not mentioned anything about liabilities, what is the assumption? If they have not mentioned whether it is taken over or not taken over, what is the assumption? It is taken over at the book value. So this gratuity liability is taken over at 20,000 only. So minus 20,000 euro. Done now. Okay, anything else is there? Yeah, we have trade payable worth how much? 80,000. Creditors. Nothing mentioned. So what to do? Assumed that it is taken over at book value. Minus 80 you do. Getting it? Anything else is there? No. What is the number you're getting? That is what? Net assets. Because what you essentially did is you took over all the assets at agreed value. You reduce all the liability at agreed value. That way you will get what? Net asset. But we have an approach. What is the approach we newly learned? If PC is missing, net asset only will become PC. So the total PC is also how much? Done now. This is the working note. Number one. Here, net asset ka working note, PC ka working note are same. Because net asset itself is PC. No, not here. If mutual owings are there, means it will not affect PC ka working. Right? You have to cancel mutual owings only in the books of the purchasing company. I had given you husband-wife example in regular class if you remember. Only few are there. Okay, so that's the logic, but I don't have much time to go into that. Yeah, but yeah, to tell you a point here, don't do anything. Cancel as an entry. So far, okay. So what is over now? Net asset is over. PC is over. What is the third step? Compare PC with net assets. Either you will get a profit scenario or loss scenario. But here PC and net assets are same. That means will you get any extra goodwill? No. Will you get any capital reserve? No. Because it is same. That's all it is. Manageable people. But goodwill is already there, no sir. This goodwill we calculated or it was given to us? This was given to us. Other than this, no extra goodwill or no extra capital reserve will come into picture because PC and net assets are same in this particular question. That working not over. Correct, Aji? Now, totally how much is a PC? 5,30,000. PC will be given to whom? Owners. There is one owners here or two owners? Two owners. Who are those? Preference shareholders, equity shareholders. To preference shareholders, we clearly know how much we gave. We made a note of it also. Instead of giving 1 lakh, we paid 10% premium. That means we paid them how much? 1 lakh 10,000. So what is the indication? Total PC is how much? 5,30,000. In that 5,30,000, 1,10,000 we gave it off to preference shareholders. The balance remaining will be taken by the risk bearers, which is what? Calculated or balancing. That is what as the question says necessary. Necessary means whatever is remaining. How much is that? 4 lakh. That 4,20,000 will be given to equity shareholders as PC. But this 420 you settled by cash or question told shares. Equity shareholders of selling company Vayu will be issued necessary equity shares at 5% premium. Okay, Naji. There's some significance for this, which I'll tell you also. Done now. Now, entries. Sir, whether it is purchase method or merger method, 3 journal entries will come in everything. That's a common entry. First journal entry is, what did the purchasing company do? They purchase another company ka business. So first entry is always business purchase account debit to what happened to Vayu now? Selling company there or it shut down? Whenever a company shuts down, to see this process, we appoint an external person called liquidator. So that there is no like fights and all that. So the PC will be given to the liquidator and liquidator will distribute it to the necessary person. So the first entry is always business purchase account debit to liquidator of selling company, which is Vayu. We purchased the business by paying how much PC? We calculated that. 5,30,000. That is the entry you will pass. Business purchase account debit to liquidator of selling company. Yes, sir. Sir, when you purchase someone's business, what will you get? Suppose you purchase ArivuPro ka business, what will you get? You will get ArivuPro ka assets as well as ArivuPro ka liability. Alright. Now, since Hari Limited purchased Vayu ka business, Vayu ka all the assets and liabilities now belongs to whom? Hari. So, that means Hari has to show that asset. Asset has what balance? So, all the assets taken over, you'll have to debit one by one. That's the second entry. Because now Vayu ka assets has been taken over by Hari. Which all assets? Again, you don't have to read the question. You anyway calculated net assets. Net assets means what? Asset taken over at agreed value. So PC ka working note has all the assets. Debit all of them one by one. Because all the assets come in with what balance? Debit balance. From goodwill till cash and bank, all the assets you debit. That's what they've done here. Check. 50, 150, here 160, 157, 500. All the assets from goodwill to bank account they've debited. Any doubt? Quickly reviewing. Hope this is okay with you. Yes. All assets you will debit. You'll only get assets or also liabilities. 3 liabilities I think we took over. What are those? I think 2 rather. Gratuity and trade payable. How much? 20 and 80. So that we will credit. Yes, sir. So assets account debit to liability account. Sir, you have done many balance sheets, right? Have you seen any business purchase in balance sheet? You have seen equity share capital, you have seen debentures, you have seen reserves. Have you seen business purchase? I mean, is this an actual account or a routing dummy account? Dummy account. Here you have debited. How do you cancel that? Credited. So just credit. Just for the sake of routing these entries, we pass it through here. Because today, if you decide to amalgamate, today only you will get all assets. Huh? Today you might have entered the agreement, but the actual flow of assets may happen after 1 week possible. Hence, when agreement is finalized, we pass this entry. When you actually record the assets, we go on passing this way. So business purchase here we have debited. How do we cancel this? Credited. Yes, sir. Yes, sir. Correct. This one they've shown it separately. You don't have to worry about that. We directly will show the debtors. So don't worry about why debtors is shown at 1 lakh. We did not take over debtors at 1 lakh. We took over at 7.5% lower. They have shown debtors at 1 lakh and they have shown provisions separately. Instead of that, directly you write debtors only as 90 to 500. It is fine. That's all right. This is the thing. Okay, first entry, reiterate it back to me. Tell me once again, what is the entry first? Business purchase account debit to whom will the PC be given to? Owners. Directly we will give it to the owners, or there is one more person to help the process? Liquidator. Hence, business purchase account debit to liquidator of selling company. When you purchase a business, you will get assets as well as you will get liability. All the assets will come in with the debit balance. All the liabilities will come in with credit balance. Business purchase is a routing account. So hence, we cancel that by crediting it. So far, any questions? No. Sir, how much PC we have to give? 5,30,000. Can we just say liquidator and keep quiet, or we have to settle? Settle. Is this 530 given in the form of cash? This 5,30,000, what we have written it as liquidator of Vayu here, concentrate here, it's okay, right? Liquidator of Vayu Limited is 530. This 530 we gave cash, or how did we give? This is PC. PC was given to 2 people in 2 forms. What are those? Go back to that adjustment. To the preference shareholders, we said preference shareholders are to be paid at 10% premium by issuing what? 9% preference shares of Hari Limited. So, one form of PC is settled by issuing new preference shares. How much percentage? When a company issues new preference shares, for that company it is a preference share capital. So, you will credit what? 9% preference share capital. To what extent? How much did we give as preference shares? So to preference share capital, we will credit 1,10,000. Yes, Aji. Yes, Aji. Balance this 4,20,000 was given to equity shareholders as PC. But was this 420 settled through cash or new equity shares? Check this. What did they say? Equity shareholders of Vayu Limited, that is selling company, will be issued necessary equity shares at 5% premium. Okay. Now here there is one small concept. What is this? This is important adjustment. Many of them kind of lose out marks on this. Sir, whenever you see the word premium, I have dictated this in regular class just for this thing. Pay attention to this. This can save you around 2 to 3 marks. Always check when the word premium comes, where it is used. In that sentence, where the word premium is used. Now, sir, check this. What do I mean by that? Equity shareholders, pay attention, important. Equity shareholders of Vayu Limited. Correct? This is old equity shares because Vayu is selling company. Will be issued necessary equity shares. This is what? Old shares or new shares? At what? 5% premium. So there is a word premium used. Always check whether that premium word is used next to old shares or new shares. The word premium is put next to old shares or new shares. If it is put next to old shares, it means we are taking over the equity shares at a higher value and giving the new shares at par. What did I say? Tell me once again. If this word premium, like here, check this adjustment. Read this adjustment. 10%, important, 10% preference shareholders are to be paid at 10% premium. This 10% preference shareholders means it is a old preference shares. They are paid at par or 10% premium. So this word premium is used next to new or next to old. Old, right? By what? By issuing new 9% preference shares of Hari Limited. That means this is new. Now, tell me, in this reading this line, what can you make out? The word premium is used next to the new component or the old component? Old component. When the premium is used next to the old component, what it simply means is we are taking over. What is the preference share capital of the selling company? 1 lakh. We are not giving them 1 lakh. We are giving 10% more. We are not taking over this at 1 lakh. We are taking it over at 1,10,000. Is that okay with you? And how is this 1,10,000 settled? By issuing new shares. New shares are not issued at premium. New shares are not issued at premium. New shares are issued at par. Only the old one is taken over at higher value. Why am I saying this? Sir, when shares are issued at premium, you credit something called securities premium account. Now you're passing journal entry. Share capital is always shown at face value. Premium element goes to securities premium. That's the reason it is important to identify whether the old one is taken over at higher value or new shares are issued at premium. So that the key word there or the differentiating factor or one quick way to identify that is same words I had given in my class also. Check where the words premium are used. If this word premium, if it is used next to the old component, that could be old equity shares or it could be old preference shares. That means what? What is the indication of this? If it is the word premium, if it is used next to the old, it means what? The old component is taken over at higher value and new shares are issued at par. New shares are issued at par. But if the same words premium, if it is placed or if it is put next to new component, that means new shares are issued at premium. And when new shares are issued at premium, you have to compulsorily include what? Securities premium. Understood this or this? If you want, you can make a note of it. Yes, value it's already included, but we need to bifurcate between share capital and securities premium, which I'll tell you once again. But did we understand? Many of them will get this wrong. 2-3 marks easily they will lose because of this. So this is one easy, quick way to identify what is happening here. Done now. Okay. Just to be looking at your confidence, I would like to tell it once more. What does it tell? Or you tell? Premium. This whole drama is around premium. The whole drama is whether the old one is taken over at higher value or the new shares are issued at premium. Because if new shares are issued at premium, in your journal entry, you have to record premium in securities premium. So how to identify that or decode that? Check where the words premium are used. If you check preference shares, what did they say? Preference shareholders are to be paid at 10% premium by issuing 9% preference shares of Hari. So this premium came next to what? New one or the old one? Old one. Hence the old one is taken over at higher value and new shares are issued at par. New shares are issued at par. That's the indication. But if same sentence, if you read it for equity shareholders, check the sentence. Equity shareholders of Vayu Limited will be issued what? Necessary equity shares. I mean, this is necessary new equity shares at 5% premium. This word now premium is used next to old one or the new one? This word's premium is used next to the new one. If the words premium come next to the new shares, what is the meaning? New shares are issued at premium. That is the meaning of it. That's a simple way of decoding the things. Yes, sir, people. Take your calculator, all of you. Take your calculator, all of you. Sir, how much are we giving as total PC? First tell me that. How much total PC we have to pay? 5,30,000. In this 530, how much preference shareholders took off? 1,10,000. Easy now. How much is the remaining? 4,20,000. That remaining will be given to whom? Equity shareholders. Yes, sir. And this 420 is settled by cash or new equity shares? New equity shares. And this new equity shares, my dear friends, are not issued at par. It is issued at premium. Yes. Okay. The face value of this new equity shares is 10. So how can you tell 10? It is given in the question. I made you underline also. The equity shares ka face value is 10. But is it issued at 10 face value or 5% premium? 5% premium. So how much is the premium element? Tell me. 10 ka 5%, which is 0.5. That means issue price is how much? You are not issuing the new shares at 10. You are issuing it at 0.5 rupees more. So the issue price is 10.5. Nanna. Pakka na. How much you have to give? 4,20,000. You have to totally give 4,20,000 and the worth of one new equity shares is 10.5. You have to totally give 4,20,000 to the equity shareholders and the worth of one new equity shares is 10.5. So how many shares you have to give? 40,000 new shares the company has to give. Akkana. Equity share capital always shown at what value? Face value. So 40,000 new shares are issued and the face value of one share is 10. So of this 4,20,000, 4 lakh will be credited to equity share capital. Balance is a premium element which will be transferred to securities premium. How many shares? 40,000. What is the premium per share? 0.5. That means how much is the total premium? 80,000. This is a bifurcation. There's a good adjustment. Easily 2 marks to minimum will be allocated for this. Most of the cases. Yes, sir, people. Now go back and tell me the entry. What and all you give to the liquidator? 2 things. Preference shares, equity shares. What is the entry? Liquidator of Vayu Limited account debit. Totally how much you need to pay? 5,30,000. First component we give to the liquidator is preference shares. If a company issues preference shares, can we say preference shares or preference share capital? Preference share capital. How much preference share capital we have issued? 1,10,000. So liquidator of selling company account debit 530 to preference share capital account 1,10,000. Balance is 4,20,000. Don't write to equity share capital 420. In that 420, the face value of equity share capital is only 4. 20,000 is a premium element which has to go to securities premium. So this whole working was for these two bifurcation. That's all. One easy way, again I'm saying, is what, sir? How to decode? Check where the words premium are used. The security premium will only come if the words premium are used next to new shares. Otherwise, it will not come. That's a easy, quick way, quick fix to identify. These are 3 journal entries. It will come whether it is purchase method, merger method, or purchase method or merger method. Tell me the entry once again. We are doing it properly. Okay. Otherwise, no. I don't like to go back to Bangalore thinking I could have done a little more. I feel guilty conscience. I know that you are feeling hungry conscience, but I will feel guilty conscience later on. Okay. So it's okay. Another 15 minutes. Don't worry about sapad and be here only. Sir, now 15 minutes, sir. Leave na. Why you making, tell me time and all. Sometimes here and there it goes. First entry. First of all, you are passing the entry in the books of selling or purchasing company. Which method? Purchase method. First entry. Business purchase account debit to liquidator. When you purchase a business, you will get some assets and you will get some liability. Assets will come in with debit balance. Liabilities will come in with credit balance. There is a dummy account to be cancelled called business purchase. That's your second entry. Third is PC ka settlement. PC will be given to liquidator and liquidator will later distribute it to whoever has to get it. So the entry will be what? Liquidator of the selling company account debit to whatever. If you have paid cash to the liquidator, you will credit cash. If you have issued preference shares, don't write preference shares. Credit preference share capital. Because for a company issuing preference shares, it is preference share capital. If you have issued equity shares, then you credit equity share capital. But do not forget to bifurcate or separate between face value and premium element. That's one thing. Okay, now, other than this, you may get some 3 or 4 extra adjustment. Amalgamation expense, stock reserve, statutory reserve, mutual owings, all those are additions. If it comes, you already know the entry. Bring it in your product. That's all is amalgamation. Okay, now, take this as a base and build, like solve 3-4 questions overall. You'll be able to manage them. This is in whose books? Purchasing company. And one new takeaway we got it is, if PC is missing, if PC is not mentioned in the problem, calculate net assets, and that net assets only will become PC. One more aspect we'll have to do it here is selling company. Ayyo no andrena, we are doing only and we leaving. Alright. Selling company, you already know what account you'll open pa? Realization account. And 6 components you have to transfer it to equity shareholders and make it balance. Right? After all 5 minutes, chindi work, we will do it one by one. First step in realization account. Who's doing this activity? Selling company. That is why realization account. Okay. All right. First, transfer all the assets. Market value or book value. Intention is to close the ledger. Ledger is not shown at agreed value. Ledgers are shown at book value. Transfer all the assets. What is the entry? Assets have debit balance. To transfer, what we'll do? Credit it. So the entry will be realization account debit to sundry asset. In fact, in all our class, we used to show individual asset, but ICI don't know mother body. So what so nicely she felt about you. See how many assets our selling company has. They have many, no? Here to here, right? I feel each asset should be credited individually because each is a separate ledger. But ICI gave one shortcut. Add all this. What are you getting? 6,30,000. They directly pass the entry realization account debit to sundry assets. Actually, this was agreed value. Sorry, you can't take this. You have to add the book value. When you add book value for all the assets, if you want to do it off, okay, take a calculator. Vayuka, book value in balance sheet is 250. Add. Intangible asset is 25. Add. Inventory is 175. Add. All this from here to here, you add. All this you add. How much are you getting? From here to here, if you add, what are you getting? 5,70,000. That's what they've done. To sundry asset, 5,70,000. If ICI gives shortcut method, labuk. Don't even think twice. Take it. I personally feel you have to show each assets individually because each is a separate ledger. But shortcut mother body is okay. Then what are we to discuss on that? Fine. Now, this is to close what? This is to close all the assets. Next step. Close all the liabilities. Come back to question ka balance sheet. What in all liabilities we have? We have long-term provision. This is your gratuity liability and trade payable. These two. How much is that? 1 lakh. I don't know. This one they've combined or showed it separately. 2080. Entry you tell me. Then we'll see. These two liability. Both this liability have credit balance. To cancel? And debit. So liability account debit to realization. So when you post this in realization, you will post it as by liability. They've shown it separately. Retirement 20, trade payable 80. Done. Asset closed, liability is closed. Third step. Go in that step manner only so that it becomes easy. Selling company will sell the company at free of cost or they will recover. What they will recover? PC. Right? PC they will recover from whom? Purchasing company, which is Hari over here. I mean, Hari becomes your debtor. Debtors will come in with credit balance or debit balance. What is the entry? Hari account debit to realization account. This is to the extent of PC. PC we have to still calculate or already done? Already done. How much is it? Yes, sir, people. There is no amalgamation expense. There is no reimbursement of amalgamation expense. There is no asset not taken over. There is no liability not taken over. Even if they were there, we have already discussed in format. You know what to do. Over. There was one thing about preference shares. I told you I'll do it in this problem. And this is an extra checkpoint you'll have to remember to yourself. Whenever preference share capital, whenever selling company has preference share capital, before realization account, always prepare preference shareholders account first. First you prepare preference shareholders account, then you prepare realization account, then you prepare equity shareholders account. Don't change the order. Why? I'll tell you in a bit. Now, preference shareholders, they will get what? Preference shareholders will get what? Preference share capital. Come back. Check the question. 2 minutes. How much is preference share capital of selling company? 1 lakh. This is also ledger. Can you keep it open or close it? Preference share capital has what balance? Credit balance. How do you close it? Debit. This capital has to be repaid to whom? Preference share holders. Tell me the entry. Tell me the entry. Preference share capital you need to close. preference share capital has credit balance. Something which has credit balance, how do you close? Debit. So the entry will be 10% preference share capital account debit to preference share holders account. Now, when you post the same entry in preference shareholders account, you will post it as by preference share capital 1 lakh. Correct? Yes. With this preference share capital, ledger is officially closed. Done. What did the preference shareholders get? Did they get cash? If we pay cash to preference shareholders, what is the journal entry? If we pay cash to preference shareholders, what is the entry? Preference shareholders to cash. Did preference shareholders get cash or they got new preference shares? That means what entry you will pass? Fill it up for me. Preference shareholders account debit to new preference shares. Don't write preference share capital because it is capital for the company issuing. Who issued? Purchasing company. We are doing all this in purchasing company books or selling company? Selling company did not issue this preference shares. Who issued? Purchasing. Just that preference shareholders got it. So instead of writing preference shareholders to bank, you'll write preference shareholders account debit to new preference shares. So hurry, you can write like that. Done, ji. The value of new preference shares is 1 lakh or 1,10,000. 1 lakh or 1,10,000. I mean, this value will write it as 1,10,000. Oh, Govinda, why? Sir, this side 1 lakh, that side 1,10,000. Not matching. There is a difference. How much? Sir, if preference shareholders get more, actually they had to get how much? Actually they had to get only 1 lakh. But reality, how much did they get? 1 lakh. If preference shareholders get more, another shareholder will suffer a loss. Who is that? Correct. Yes, realization profit or loss also you transfer it to whom? Equity share. So if there is any balancing figure in this account, that you transfer it to what? Realization. Because this 10,000, it may be profit for the preference shareholder, but as far as equity shareholder is concerned, it is a loss. Because they got 10,000 less. Yes, no? Yes, sir. So hence, this particular adjustment affects which account? Realization. So unless you know this, you will not be able to close realization. Hence I said, whenever selling company has preference share capital, first prepare preference share holders account, then realization account, and lastly equity share. So that way, if you take care of this order, the mistakes will not be done. Okay, Navibal. What did you post it as here? Quickly tell. Entry is what here? Realization account debit to preference shareholder. So when you post this entry in realization account, it will come as what? To preference shareholders 10,000. That is what I have written in the chart here. In my realization account, I have said here, see, to preference shareholders account 10,000. This adjustment will only come when you have paid same value to preference shareholders or extra values. That's what I've written. If the amount paid is in excess of preference share capital, then this adjustment will come. But you don't have to know this. You number them. How will you prepare? First, always preference shareholders account, then realization, then equity shareholders. That way you don't have to remember all these wordings. Automatically it will get taken care of. Yes, sir. All right. Sir, any balancing figure in realization account is what now? Realization profit or realization loss. Here the balancing, okay, tell me this. Don't. Here balancing figure is coming on the debit side. What is it? It's a loss or profit? Profit, perfect. This is profit on realization transferred to which account? Calculated or balancing figure? Need a minute to review? That was very quick. It sounded personal. 15 minutes. All the father is going on extending. Now you're asking review time. All right. So this is sorted. Last equity shareholders account. 6 components. This was more personal. Okay. Equity shareholders 6 components. Tell me, Pachapandi, what are those 6 components? Equity share capital, all the reserves and surplus, miscellaneous expenditure or deferred revenue, whatever. Realization profit or loss, PC, surplus cash. All will not be there, but this is for our checkpoint. Post it and it should match. Let's see. Okay, one by one posting. Equity share capital of selling company is how much? 3 lakh. Tell me the entry for this. Let's do it with entry maybe. 3 lakh is the equity share capital of selling company. This ledger also we should close. Equity share capital has what balance? Credit balance. How do you close? Debit. So that means the journal entry will be equity share capital account, debit. I'll do a compound maybe. To equity share holders account. How much? 3 lakh, 3 lakh. Any doubt? One component transferred, one checkpoint done. Second one. Second, reserves and surplus. How much is the reserves and surplus of selling company? 70,000. Which reserve? General reserve. General reserve has what balance? Credit balance. How do you transfer? Debit. Entry is what? General reserve account debit to equity share holders account. How much? 70,000. Okay, Naji. Now this entry, if I have to post it in equity shareholders account, where it will come? If this entry, if I have to post it in equity shareholder ka ledger, where it will come? On the credit side, you will post it as by equity share capital, 3 lakh, by general reserve, 70. Two sorted. Third one. We'll go in our own order. Miscellaneous expenditure, deferred revenue expenditure. Available or not available? Not available. If it was there, what entry you would have passed? Miscellaneous expenditure and all is still an expense. They will have what balance? Debit balance. How do you cancel them? Credit. That means that you will credit miscellaneous expenditure. Where are you transferring this to? In this problem, there or not there? Not there. So we don't have to worry. This is sorted. Fourth one. Realization profit or loss. Check your realization account. What did you write here? Realization account debit to equity shareholders account. So in your equity shareholders account, what will you post it as? By realization account 50,000. Yes, sir. Same entry. Fourth one is done. Fifth one. PC. If you pay cash to equity shareholders, what is the entry? If you pay cash to the equity shareholders, what is the entry? Equity shareholders to cash. Did we give them cash or new equity shares? So what is the entry? Equity. Daivame, don't write equity share capital. It is capital for the company issuing it. New shares are not issued by the selling company. It is issued by the purchasing company. But we are doing all this in the drama of selling company. What entry will pass? Equity shareholders account debit to new equity shares of Hari. Like that you can say. How much is it worth? 4,20,000. We already calculated that, no? In 530, preference shareholders took 110. Balance 420 was given to equity shareholders. That we have posted. Yes, sir, people. Surplus cash. Here, cash of the selling company was missed out or already taken over? Already taken. So that means we don't have any surplus cash. Check this side total 420. That side also 420. Congratulations, you're finished. Okay. One more problem was there. Merger ka. I don't think so. You'll leave me to do it. But do keep in mind merger method ka. Compare PC with paid up capital and adjust it in what? If it's a loss, adjust it in general reserve. That was the next problem which I wanted to discuss. I think it's not possible. And if they ask balance sheet, okay, or one second, hang on, one second. If they ask balance sheet, how will you do it? This alone, just balance sheet, what do you do? Take Hari Limited ka balance sheet value as it is. Purchasing company ka balance sheet value, you take it as it is. Vayu Limited ka you will take over at book value or agreed value. All the assets liability you will have to add at agreed value. That way if you do, balance sheet will match. That's a simple funda of balance sheet. And do not forget mutual owings. What do you have to do? Mutual owings you need to cancel. Mutual owings can come in the form of debt or credit. So if there is mutual owings in the new balance sheet, you'll have to reduce it from debtor also, creditor also, bill receivable also, bills payable, loan taken also, loan given also. This is one. If there is stock reserve, adjustment, you will reduce it from closing stock if it is there, right? If there is statutory reserve, you have to show it. But two components will come with statutory reserve. What is it? One is the statutory reserve itself. Another one is amalgamation adjustment reserve. Both fortunately will come in reserves and surplus only. One with a positive balance, another one with negative balance. Yes, sir. Amalgamation expense. Do not forget that, right? That will affect your goodwill and it will affect your bank balance. So just check that entry ka and accordingly add it up. That is there. We have done enough questions, but since you are in a different zone now, I don't want to take up the balance sheet. So this was your summary of amalgamation. Thank you for your time and patience. So let's take a break, and half an hour break is okay. But you tell it's okay. I mean, I'm okay as long as you are ready to stretch a little bit later. We have, I think after this we have consolidation. We have consolidation will take another 1.5 2 hours. Then AS 23, 27. Mostly AS 4 and 5 we can't do. We'll have to leave it at 3 more at least. So we have to do 3 hours more. No, yeah, roughly 2.5 hours to minimum is required. Okay, half an hour or 40 minutes. What do you want? Your call. I'm okay. 40 minutes. Okay, let's resume back in 40 minutes. Thank you.